Very good afternoon, friends, and welcome to this budget webinar uh, uh, to discuss or deliberate upon the recent finance bill 2022 presented by the finance minister in the parliament. The the finance bill that we have, it has received a mixed reaction. But for our for the tax fraternity or the professionals, I may state that the provisions of the finance bill, there are in all more than 40 amendments in direct tax provisions, and several of them are important and very significant, which may have implications or implication and bearing on for your for the corporates or taxpayers. Uh, these to name some of the provisions, for instance. Uh, there is a new scheme for taxation of virtual digital assets, that is known as crypto, that's quite in vogue and fashion. There is a scheme for taxation of virtual digital asset has been announced. There is significant amendment proposed for litigation management. There is a provision for filing an updated return for declare undisclosed income. There is a total revamp of faceless assessment scheme. There is a revamp of or significant amendments in the reassessment procedure. Uh, there is a new TDS or tax deduction provision, or a new item of tax deduction provision has been introduced. A very significant change, requiring a deduction of tax at source from of any benefit or perquisite paid in respect of any business or profession. Now, some of more amendments that have been made, they have been proposed, I would say, to undo settled judicial position which have been taken by the courts. Several of them have also been made effective retrospectively. So there is a wholesome plate in front of us. There are a lot many changes which we need to deliberate and discuss. We have with us the leading luminary, Mr. Ajay Vora, senior advocate, and we have the benefit of his expert views on each of the proposals or amendments that we have that has been proposed in the finance bill. Then my friend and the partner, senior partner of Vaish Associates, Rohit Jain, he has over 22 years of experience of dealing with complex issues related to direct taxes. He has represented many complicated, big ticket direct tax litigations before the courts, and he has, I would say, a neck for resolving the complex problems and giving solutions to complex issues, tax related issues. Then I'm a partner at Vaish Associates. I shall also be, we shall be basically taking you through the various provisions of the finance bill. We shall be stressing and deliberating in detail some of the significant provisions. While we have compiled and will be presenting a PowerPoint presentation dealing with each of the amendments, and which will be shared to all of you after this discussion, at the after end of the discussion. Lastly, Arun Giri, I would say I call him a household name for the tax fraternity. He is kind of a live wire so far as tax or business journalism is concerned, and he's founder editor of Tax Sutra, the popular tax portal. He has extensive experience, and he'll be in business and tax journalism, and his previous stint has been with Bloomberg. So he'll be moderating the session, I think you can put your questions. We have a long way to go, and there are many provisions which would require which would take a lot of time in the deliberations. So we would request that you may keep posting your questions in the chat box. We shall try to respond as and when we can, in the maybe in the course of the discussions or maybe thereafter. So over to Arun. So you may maybe start.
Thanks so much, Neeraj. Yesterday only I was telling that when I used to come to Delhi in the pre-pandemic era that started 2 years ago, that actually till about 2 years ago, we used to look forward to a gathering at the Lalit, and and I distinctly remember one of those sessions. It was such a pleasure moderating it, and there was so much to do with black money, tax evasion, tax avoidance, GAR, SAR. Oh dear, that was one hell of a session. And I still remember Ajay ji so passionately arguing that you are literally driving the rich out of this country. I can't see Ajay ji. Maybe his video is muted, but yeah. So it's an absolute delight to be moderating this session. And when you have a luminary like Mr. Ajay Vora in the panel, quite honestly, the only thing that I need to do is to fire questions. Whether they pass the mark or not, Ajay ji's answers, are sure to be a big hit with all of you. The way he, since I've moderated so many panels with him, at least a dozen or more, I can tell you that the way he looks at the bill is a testimony to the rarest of rare dual qualifications and expertise that he has as a chartered accountant and as a lawyer. Both. I can only profess to be a chartered accountant and a journalist, but Ajay ji has a combination that is very rare. I think Mr. Salve has that combination, chartered accountant and a lawyer. Ajay ji not only argues cases on domestic law, domestic tax, corporate tax, international tax at the High Court and Supreme Court, but is one of the most renowned lawyers sought after for his opinions on intricate, complex, complicated tax matters, which is only getting more and more complicated by the day. And I'm sure many of you all will be making a beeline for his opinions in the next 1 year, given the spate of amendments that have happened. You know something, the devil, they say, always is in the fine print. So the day on the budget day, you and I was on a business channel panel, and everyone was looking at the Sensex. The whole headline was about 7.5 lakh crores of capex, and how it's going to unleash the animal instincts in the animal spirits in the economy, and it's going to lead to the a spurt in GDP numbers and employment and so on and so forth. So that was a headline. 7.5 lakh crores of capex. This is a government which is willing to go the whole hog when it comes to spending. You had the big headline a month or two back with the Air India disinvestment, essentially doing what no government has dared to do in the last 20. The other government which was so bold on PSU disinvestment, but actually lost an election after that, was the Vajpayee government 20 years back. So it's a government which has been bold, not necessarily to everyone's liking, definitely not to Ajayji's liking on some of the proposals in the past budgets. So this budget, let's first start by asking Ajayji his quick initial take. There were a couple of budgets, Ajayji, where you definitely were irked by some of the proposals, very strongly, in fact. This budget passes muster with you on the tax side, sir?
I think, Arun, to be fair to the finance minister, every budget, brings new challenges, brings opportunities for new assignments, new issues that keep arising. So I don't think the budget, this year's budget, will also fail on that account. I think there will be opportunities galore with respect to litigation, with respect to opinion writing that you mentioned about. So I think, so far as the budget is concerned, the amendments are fewer, the budget speech was shorter. So we are only hoping that there is a stability in the tax system that will emerge in the years to come. But I think one thing that disturbed me this year and in the last year, I think unknown to most people, many of the budget proposals are already applicable. You see, if you see the headline of the budget, it is applicable from 1/4/22. That means for assessment year 22-23, which is currently underway. So from 1st April of 21, many of the provisions are already applicable. So in that sense, it is retrospective. It is retrospective going back 10 months. Some of the provisions are made applicable from 1st April 21, some very few from 1st April 23. Most provisions have applicability for the current financial year, which is underway. So I think that is an issue that is not highlighted, but that's an issue which is, like you said, the devil is in the fine print. That is possibly when you dissect the budget, you analyze that many of these provisions have their root from 1st April 22 and are and are applicable for the current financial year.
Yeah,
so other than that, there are some major amendments which we'll debate in the course of the discussion. I did not want to jump the gun.
I'll ask you a couple of questions which otherwise will not get covered. Millions and millions of taxpayers are asking on social media, "Humko kya mila?" A lot of jokes, memes are coming on WhatsApp, on Twitter, Facebook, whatever. And the middle class has got nothing. In fact, one of the jokes today shared by a senior advocate who's not in tax, Sanjay Ghosh on Twitter, was that the rich get, the poor get the subsidies, the rich get the rebate, the middle class gets the debate. They enjoy the debate. But so I think this is a fair question. Right. You have record tax collections, 18% more than the budgeted estimate. 12.5 lakh crore revised estimate versus 11 lakh crore. This is a question I'm asking on behalf of the millions of middle class taxpayers, including me. What has the middle class got?
No, but I think, Arun, to answer your question, the larger issue is the budget intended to give something to the people? In the sense, you are looking at the direction that the budget is going to take. If you think the budget is like a subsidy document, I don't think that's the position. And I was reading today, the paper said that if you exclude in people having income below 10 lakhs, 91% taxpayers will go out. So while we are talking of robust increase in the number of taxpayers, we are talking of robust increase in tax collections. It is coming from a minuscule number of people or taxpayers. And look at the number of taxpayers vis-a-vis our population. So I think the larger issue which somehow is missing most governments is how to broaden the tax base. And the government in this direction is wanting to encourage voluntary compliance so that more and more people come forward and voluntarily file their correct taxes, so that tax collections can be showed up. I think that's a direction that we should take. And you look at most advanced countries, most people pay their own taxes faithfully, correctly, without any nod or nudge from the government. That is treated as an obligation, that is treated as a duty of every citizen. I think we have to
Yeah.
reach that goal. And then one can possibly say that, this is something that you're getting in return from the government in terms of electricity, water, which we should be taking for granted in the years to come.
Yeah. The finance minister started a speech by saying that direct tax, the overall philosophy of the amendments is more reforms that will establish a trustworthy regime. The last 3-4 years, we've seen 100 amendments each in most budgets. They've taken a direction. If say one budget focused on black money, the other budget focused on tax relief, another budget may have focused on incorporating the direct tax code proposals, going faceless, and so on and so forth. You've had all these focused budgets in many ways. When you see this budget, do you feel that it is more status quo-ish? Or do you think because we've got the virtual digital assets, the updated return, it also ticks the box on the reform score, according to you?
No, I think it must keep pace with the changing times. And rather than the government waking up 3 or 4 years later, after the horses are bolted the door, it is better that the government keeps abreast of what is happening in the world across. And today technology is changing so frequently and so fast that it is important that we keep pace with the times. So to that extent, I think this virtual digital asset is a recognition of what is going on in the world. We are losing our share of taxes with respect to this particular commodity. So I think the government has done well to bring in this amendment.
Sure. On the policy side, sir, when you look at, and the reason I'm asking it is when you look at drafting and other things, nothing happens in a vacuum. Everything happens in a larger context. And as they say, surrounding circumstances, as they say in many judgments, even on the tax side, it's all about the facts and surrounding circumstances, everything. The surrounding circumstances for the last 24 months has been pandemic. Has the policy response on the tax side, both in and out of the budget, because so many of the responses have been outside the budget, have you been satisfied generally, sir, over the last 24 months on the tax response to the pandemic?
I think the government has done well. I would say that, on the policy side, they have in this budget ensured minimal changes. They are seeking to ensure stability. Even on the processing side, I think I would compliment the way they are up to speed. I was surprised that I filed my daughter's return only a couple of months back and this is already processed. I received the processing, a day or two earlier. But having said that, I would only say that much is left to be desired so far as administration of taxes are concerned. While for majority of taxpayers, the processing happens, returns get accepted. But wherever there is a scrutiny, I think the mindset must change of trying to cut down on frivolous additions. The faceless should be a good experiment. There have been some good decisions from the faceless regime, but equally, there have been substantial litigation before the courts where opportunity of hearing has been denied, and therefore it has resulted in high-pitched assessments. On the administration side, if the government is only going to pull up its socks, I think we will have an equitable tax administration in the years to come.
Faceless assessments, GST, and IBC. How would you rate each of these three regimes on a score of 1 to 10? Each of the three. Faceless, IBC, and GST.
No, faceless, I think, is very early days. The initial experiment, at least for people in Delhi, has not been too good. There have been too many writ petitions before the High Court. That could have been avoided, to my mind, if adequate attention had been paid at the level of the faceless assessment to, afford adequate opportunity of hearing to the taxpayers. But I think it was a transition stage. We will have to give it to them. It was a transition stage. GST, I'm not really an expert, but I only read the numbers to say that how collections are increasing. But since the GST matters also come in the same tax court where I also practice, one sees a lot of litigation around GST. So I think that area is also rife with substantial disputes being raised by the tax department. And I invariably find most of the disputes relate to release of refunds. So there is large money locked up for assessees so far as GST is concerned. IBC has got off to a good start. There are again substantial litigations around it, but it is maturing into an excellent piece of legislation in order to revive, rehabilitate companies, or to put an end to a companies where there is no prospect of, reviving the company.
One amendment, sir, in this budget, which you feel absolutely should not have found a place in the document. One amendment.
I would think that 14A was
Should not
almost
have-
put to rest.
Okay.
Now, and this will give rise to a fresh set of litigation, whether that explanation is prospective or retrospective. We are almost reinventing the wheel.
Yeah, pulling a person back from the grave.
Right.
And overall, sir, overall on the tax proposal side, on a scale of 1 to 10, 1 to 10, the amendments, how would you rate? On a scale of 1 to 10, the 84 amendments.
I would think I would give it an 8. Yeah.
If Ajay ji gives it a 8, it actually means 9. On that note, I hand it over to Neeraj ji. And of course, I'll keep chipping in with some questions in between. But you have one of the finest set of technical experts, Neeraj ji, Rohit, Shami ji, and others who will go through it. And of course, we'll have Ajay ji's intervention and opinion from time to time over the next 2.5 hours. Quite a few amendments, which I'm sure you want to hear Ajay ji's view.
Thank you. Thank you, Arun. So, friends, going ahead with the analysis of the finance bill, I hope my screen is visible. So, Arun was asking Mr. Vora that what the middle class got in this finance bill or in this budget. I would say that what middle class actually got is that there is no increase in the tax rate, and there is maybe some reduction in the surcharge. So so far as tax rates are concerned, there is no increase, no change in the tax rate presently, and rate of surcharge in case of dividend income, short-term capital gain covered under 111A, long-term capital gain 112A. So that has been restricted to a maximum of 15%. Here it may be noted that this cap of surcharge earlier was not applicable to long-term capital gain other than those covered in 112A now, but this has been made applicable to all long-term asset, including what is covered under section 112. So illustratively, what would happen is that in case of an individual falling in the highest slab of surcharge, the tax rate would reduce from 28.496% to 23.92%. So roughly there is a reduction of about a little less than a little over 4% from in respect of tax incidence. Then in respect of cooperative society, there is a slight change in the surcharge.
Yeah, Neeraj ji, I think the slides need to move. We are still on the first slide. Slides have not moved.
No, I have moved to next slide, I think.
No. We are still on the first slide.
Is it moving? Not moving.
As of now, no.
So my apologies. How can it happen? Let me do it again.
So Arun, while Neeraj is fixing this, you asked me what the middle class got. Now, at least they can say they got no further taxes. And this bogey of wealth tax and inheritance tax, which arises much before the budget is to be presented year after year. In fact, I am happy that the finance minister has not succumbed to that pressure of reintroducing wealth tax or bringing in inheritance tax. That would have been a huge dampener.
Yeah.
That would have been a huge dampener. That would have, resulted in driving capital out of India.
Yeah. Now, Neeraj, we can see it. Yeah.
Okay.
Yeah. Now we can see. Yeah. Perfect, Ajay. Well taken. Though I wonder whether that answer would be satisfactory enough. So he's saying that Ajay is saying no bad news is good news.
Yeah.
Two negatives make a positive, Arun.
Yeah.
So you're taking me back to 10th standard. Thank you.
So maybe continuing with the presentation. So basic for the cooperative societies, base tax rate have remained unchanged, except the surcharge where income of the cooperative society is less than 1 crore, between 1 crore to 10 crore, surcharge has been reduced from 12% to 7%. For income exceeding 10 crore, it remains at 12%. And alternate minimum tax has been restricted to 15%. From 18.5%, it has come down to 15%. In respect of dividend income, dividend income, as we know, is now made taxable in the hands of the shareholders, and shareholders have to pay tax on whatever dividend income they receive. So section 115 BBD provided a concessional rate of tax for dividend income received by an Indian company from a specified foreign company where its shareholding exceeded 26%. So in a way, a group company or a subsidiary company where the shareholding in excess of 26% is held by the shareholder. This provision is sought to be done away, and therefore, as a consequence, the would not apply from assessment year 2023-24 onwards. And as a consequence, the shareholder, when he receives dividend income from the overseas foreign companies, he'll have to pay tax as per applicable rate in India. So this beneficial rate of 15% would no longer apply. So this may affect many entities which operate through their subsidiary companies overseas, and they receive dividend from such overseas companies. Thereafter, moving on to computation of income, our amendment proposed under the head business or profession. So the first amendment which I am taking up is treatment of education cess. So as you would be aware, there were certain judgment from the Rajasthan High Court in Chambal Fertilizer and Chemical, and there was decision of the Bombay High Court in Sisa, Goa, which followed the Rajasthan High Court judgment, wherein it was said that in the context of Section 40A, subset clause 2, which provided for restriction on the deduction of taxes, any tax or surcharge while computing profits and gains of business and profession. So since this was payment of an education cess, and the following these two high court judgments, they said that this education cess is not a tax or surcharge, and therefore it is not liable to be disallowed, invoking Section 40A2 of the Act, which provides for disallowance of any expenditure by way of tax or surcharge. So this decision, these two decisions were in fact recently analyzed by the Honorable Calcutta bench of the tribunal, and what the tribunal discovered that the education cess when it was levied by the Finance Act 2004 and subsequently by 2011, this education cess in fact was levied as a additional surcharge. So it was actually a levy of additional surcharge, and it was termed, or it was named as education cess. So cess was only the name given, but in nature it was actually an additional surcharge. So applying the law laid down by the Supreme Court, in the case of CIT versus K. Srinivasan, since additional surcharge is also a part of tax or income tax, this was liable to be, or it should have been disallowed under section 48(2) of the Act. Now, the government benches of the tribunal, several benches of the tribunal, following these High Court judgments, 2 High Court judgments, Bombay and Rajasthan High Court judgment, have been giving relief or accepting the claim of the assessee that these education cess should not have been disallowed. In order to address this unintended claim or benefit which has been claimed by the taxpayer, this amendment has been brought in the finance bill, is proposed in the finance bill, and as it has been clarified by way of the explanation that and this is a retrospective amendment from 1st April 2005, this disallowance which is contemplated under section 40A(2) would include also surcharge and cess, additional surcharge or cess. So this is an amendment to take care of the unintended benefit or claim which taxpayers were claiming, and this amendment has been made retrospective. So considering that the law is specifically the amendment is specifically states that it has been made applicable retrospectively from 1st April 2005, I think it would not be possible for the taxpayer to state that this amendment being a substantive amendment involving a change of tax rate should be applied prospectively. Maybe we can hear from Mr. Vora on this.
I think the amendment is made specifically applicable with retrospective effect from 1/4/2005. To my mind, there is no scope for challenging this. I saw in the chat box somebody raised the question whether one can challenge this as not being constitutionally valid, especially the retrospective operation. Now, the government has, of course, made a statement that ordinarily they would not be coming out with any retrospective amendment. That was the speech, the budget speech of the then late Finance Minister, Mr. Arun Jaitley. But that cannot be held against the government. It cannot be said that that speech will operate as an estoppel and the government cannot possibly come out with any retrospective amendment. So I don't see a ground to challenge this as not being constitutionally valid or ultra vires the constitution. That's a view that has been taken, and there are differing views expressed by the 2 high courts on one side, benches of the tribunal which are divided, and the Supreme Court, rightly or wrongly applied by benches of the tribunal to come to a particular conclusion. So I think this is almost like giving a quietus to this matter. But to your last point, I don't think there is any case made out for penalty. So irrespective whether the government is to clarify or not clarify, this cannot give rise to any penalty where the claim has been made and is ultimately disallowed.
Yes, sir. Very well, sir. So next amendment which we are discussing is and which Mr. Vora also talked about is disallowance under section 14A. Now section 14A provides for disallowance of an expenditure incurred in relation to an exempt income or income which is not taxable. There has been a controversy, ongoing controversy, that whether Section 4 or 14A, disallowance under Section 14A could be made, where in fact there is no exempt income which has been earned, and in fact the courts, including Delhi High Court, has taken a view that existence of exempt income is a sine qua non for application of Section 14A. The court, in fact, has made specific reference or laid emphasis on the wordings of subsection 1 of Section 14A, that in relation to the disallowance is to be in relation to income which does not form part of the total income. So there has to be income in the first place, and for which the disallowance could have been made. CBDT, in fact, earlier in 2014 made an attempt to negate or clarify the position, their position, and so that the disallowance could be made even where the taxpayer in fact does not earn any income or has not earned any exempt income. So this in fact, even after dealing with the aforesaid circular, the courts have repeatedly been holding that where there is no exempt income which has been earned by the taxpayer, rigors of Section 14A could not be invoked so as to make any disallowance. Now it is proposed to amend Section 14A by way of inserting an explanation so as to clarify that this section shall apply and shall be deemed to have always applied in case where exempt income has not accrued or arisen or has not been received during the previous year relevant to the assessment year, and the expenditure has been incurred during the previous year in relation to such exempt income. So why I was reading this explanation verbatim was for the reason that this explanation, while it has been incorporated and it says that this is a clarificatory explanation or amendment, and it would be considered as or deemed to have always applied to a case where exempt income is not earned or accrued or arisen. The issue, the primary issue which arises here is that this amendment has been made applicable from 1st April 2022. Now, this, of course, an amendment which is dealing with the or modifying the manner in which the tax computation of a taxpayer is to be made. So whether this amendment, in fact, could be said to be only applicable prospectively and not to the past years. So that is the first question, I think, which Mr. Vora, we should ask Mr. Vora to address.
I think the explanation, as you very rightly said, is couched in a language that seems to suggest that it is clarificatory and declaratory, that this was always the legislative intent to disallow deduction for expenditure incurred to earn exempt income, whether or not exempt income has accrued or arisen or has been received during the previous year. But at the same time, this explanation is made applicable from 1/4/2022. And in your subsequent slides, I think you've referred to cases where the Supreme Court has construing similar explanations, where it started with for the removal of doubts. It has held that if it is in the nature of a substantive amendment, it can only have prospective effect. Now, so far as 14A is concerned, the additional point to be noted is courts have already dealt and expounded on the applicability of Section 14A, Rule 8D, and how the mechanism would work. If this explanation is seeking to nullify those court judgments, it is, I don't think it is, phrased in that language that it seeks to nullify what has been decided by the courts. So in that sense, also, it should only have the effect of prospective overruling of the court decisions. That's
Isn't
one.
8D machinery, sir?
8D is not machinery. 14A is a substantive amendment. 8D will come in only if 14A applies.
Fine, got it.
So now the point to be considered here is when it says that, and I'm seeking to illustrate this point, when it says irrespective of whether exempt income has accrued, arisen or not. Now look at a situation where dividend was earlier taxable in the hands of the company, or the company was liable to pay dividend distribution tax. The dividend was exempt. Now you made an investment in, let us say, assessment year 15-16, and in the initial years there was no income. Subsequently, income has arisen in assessment year 21-22 when dividend is made taxable. So can you, sitting in assessment year 15-16 when the investment was made, assume out of borrowed funds, can you say the interest was incurred in order to produce exempt income? And subsequently dividend, when it was actually received, has become taxable in the hands of the shareholder. So clearly I would think that notwithstanding the language of the explanation, it can only have effect in a situation where income is actually earned during that relevant year. And that's the reason why the courts, read down and put judicial fetters on the working of Rule 8D, where overzealous assessing officers made disallowance A, in excess of the dividend income, B, in many cases even in excess of the expenditure debited to the profit and loss account. For example, in a large investment company, you have many industrial groups which hold their investment through an investment company, and the disallowance in those cases worked out to more than the expenditure debited to the profit and loss account. And that was the reason why the courts came down heavily and ultimately put these judicial fetters saying that it should be limited to the exempt income earned, or if there is no exempt income earned qua an investment, that investment cannot be taken into account in working out the formula. And frankly, one is not able to today appreciate the basis for this amendment that is proposed in the finance bill, because today dividend has become taxable. There are very few investments will yield exempt income. So I really don't know. The idea is to upset the apple cart, to nullify the court decisions, but the question will remain on interpretation of the explanation, whether it will have retrospective or prospective effect. That's a fresh challenge that will arise, and we will probably go back to the old days when the first special bench on 14A and Rule 8D in the case of Daga, which held Rule 8D to be retrospective. Ultimately, up to the Supreme Court in SR Tele holding, it was held that it is only prospective. So look at the journey of so many years in order to decide one particular controversy. I think this will follow the same course.
Yeah, Ajayji, isn't that the bane in our country, where one amendment, an innocuous amendment, be it reassessment in 87 or 89,
right,
14A, maybe 15, 20 years back, one amendment, a life cycle of its own, a life of its own. That amendment acquires a life of its own. And one gentleman comments, Navneet comments, in fact, his concern is 14A, the 14A amendment, will it open a plethora of reassessment cases?
It is possible. It is possible.
In fact, sir, if I just chip in over here, the amendment itself is not very clear, because if you see the substantive provisions of section 14A, there is no change in the substantive provisions of subsection 1, because subsection 1 says that expenditure should be incurred in relation to the income which does not form part of total income. So there is no income which is actually forming part of total income, and we have to find out that this expression has been construed by the courts to say that unless there is an exempt income, there can't be an application of section 14A. Now, if you see the explanation also, explanation is also very, I don't know how it is worded. It says income which has not arisen, income which has not accrued, and is not forming part of total income. If the income has not accrued, if the income has not arisen, where is the question of it forming or not forming part of total income? And then considered in light of the fact that now the dividend is taxable. So what we'll effectively do is, dividend today is taxable. Dividend could have been distributed to me in an earlier years, which was never given, which was never taxed, will result in a disallowance in that year. And today the dividend will be subjected to tax. So despite the fact that income actually ultimately resulted in a taxable income, you are making a disallowance under 14A. So to that extent also, in fact, the explanation is also not very, it's not very correctly worded to my mind, because something which is not accrued, there is a question of it being included in the total income.
Rohit, you would recall it took many years to unsettle this position, starting with Daga, then you had Chem Invest. Daga said if there is expenditure, irrespective whether it produced exempt income or not, you need to disallow the expenditure. Chem Invest said you work backwards, start with the income, trace back the expenditure. Then they were diametrically opposite. And then the Delhi High Court reversed the Chem Invest judgment. Fortunately or unfortunately, the department still is using the Chem Invest special bench judgment, which has been overruled by the High Court. Correct. So what Arun is pointing out, it will take many years for the dust to settle down even on this controversy.
Correct.
Actually,
yeah. So one comment here is, and Neeraj ji may address it, can we imply that the amendment in totality is retroactive?
Arun, actually, like Mr. Vora has said, to my mind, and I think that considering the established legal principles or legal position, this amendment should only operate prospectively. It cannot be made applicable retrospectively. And the other reason which taking this discussion forward, and as Rohit has briefly touched upon it, there is no change or amendment made to the substantive provision of subsection 1 of section 14A. The language of subsection 1 of section 14A remains the same as it was earlier in relation to the income which does not form part of the total income of the under this act. So this was the basis on which the courts have been holding that if there is no exempt income, this deduction, there is no disallowance. The section 14 could be made under section 14. Now, the issues that another issue which may be litigated or which would be considered by the court is whether this explanation can override or is expand the scope of the main provision. So that's another possible area of dispute which would be going to the courts. Maybe Mr. Vora may.
In fact, just to Neeraj take this forward, as someone I think raised the question in Q&A also, whether a reopening is possible. Now look at the reopening provisions now. The reopening provisions have been changed from Finance Act 2021. A completely new scheme is there. So within 3 years, the reopening is based on the information. Probably, and then after 3 years, up to 10 years, it is based on the certain criteria, which have again been amended in this current year. Because earlier the criteria was only the asset, the income escaping assessment only on account of the asset. Now that has been amended to include two more categories, which includes expenditure in respect of a transaction, and another entry or entries in the books of accounts. Now up to 10 years or the grandfather clause of 6 years, can someone say that since there is an entry in the books of accounts for the expenditure, so therefore I can reopen your assessment for 6 years, though if this amendment had not taken place, probably the assessments for earlier years could not have been reopened. Because there was a 3 years bar. After that, reopening was not possible. And this amendment will affect.
Arun, you can just see how fertile minds are.
Yeah,
I think so. Basically,
this is what when the onset of summer in Delhi, the early onset of summer is doing to Rohit.
Rohit, basically, I think this will not be treated as undisclosed income for section 147, 148.
No, sir, the language has been changed now.
No, for expenditure also, but it talks of undisclosed income, no, or income escaping assessment.
Income escaping assessment because of an entry or entries in the books of account.
Ajay, can legal ambiguity come within the sweep of reopening? A naive question, but isn't this a legal ambiguity at best? At best, if this is a legal ambiguity, which has now sort of been clarified, does it come within the sweep of reopening, sir?
I would think that within 3 years, yes, but not the extended period of 10 years.
Good.
I think we will have to argue again that proviso will come back. And therefore, something which has attained finality Unless there is failure on our part, you can't reopen it.
Perfect. Perfect. Neeraj, you want to head to the next section?
Yeah, actually, actually, this 14A amendment would also leave certain more open issues. For instance, whether when you compute the disallowance under section 14A, applying rule 8D, whether investment yielding exempt income only is to be considered, or whether in view of this amendment, whether even those investment which have not yielded any income, whether they would also have to be considered, because this.
Neeraj, leave aside the past. I'm posing a question to you. Assume this has become law from say 1/4/22. Now you have invested in shares. Today, dividend on the shares is taxable irrespective whether dividend has been earned or not been earned. And you have made investment in shares out of borrowed funds. Now, clearly today, dividend is not an exempt income. So obviously the interest should not suffer the disallowance even under this new explanation.
Correct.
Yes, sir. Correct.
So even if it has not produced income during the year, it is not capable of producing exempt income even in the future, assuming that this law on taxation of dividend in the hands of the shareholder continues.
Yeah,
only thing is section 57 restrictions will be there where.
Of course, but we are throwing a huge uncertainty when the law itself is bound to change in this situation.
Correct.
Then another open issue is that whether the disallowance under 14A now can it exceed the exempt income. So this is also in fact whether the Delhi High Court judgment or other cases holding that the exemption deduction or disallowance should be restricted to the dividend income earned, so that, or it cannot exceed the dividend income, whether that would get now nullified, that's another open issue. So moving on to maybe the next item, which is amendment proposed under section 37. This is one of I would say the significant amendment which has been proposed in the finance bill. So this is dealing with the explanation 1 to section 37, which prohibits deduction of certain expenditure incurred for any purpose which is an offense or is prohibited by any law. So that is so there was two controversies. One, there was issue related to allowability of deduction in respect of freebies, etc., which are provided by or given by pharma companies to doctors or medical practitioners. And there was and that's in view of the code of ethics notified by the Medical Council of India. CBDT, in light of that code of ethics, earlier in 2012 come out with a circular that such expenditure incurred on freebies should not be admissible or as expenditure in view of explanation 1 to section 37 as deductible expenditure. Now courts, while the judgments were on both sides, predominantly courts have been negating this circular, and they have held that this expenditure on freebies given to the medical professionals should be allowable should be allowable deduction and should not be hit by explanation 1 to section 37, because the reasoning of the court has been that this MCI guideline would bind only the medical professionals, but not to the companies or the pharmaceutical companies who are actually incurring this expenditure. So that for that reason there would not be any basis to invoke provision of explanation 1 to section 37. Now it is proposed to introduce explanation 3 to section 37 1 to to kind of address this unintended benefit as the tax department is perceiving it to be, that any expenditure incurred for any purpose which is an offense or which is prohibited by law would inter alia include freebies, etc. So there are, in fact, the explanation is sought to be expanded by incorporating these three items in explanation 3. Any expenditure incurred for any purpose which is an offense or which is prohibited by any law in force in India or outside India. So this outside India is an addition, and it's so it will bring into its ken any expenditure even incurred outside India to provide any benefit or perquisite to person. I'm skipping certain words, in violation of any law or rule or regulation or guideline, as the case may be, for the time being in force, governing conduct of such person. So they have, in fact, now they are looking at the person who is receiving this benefit or perquisite. So earlier, as you would have noticed, the courts have said that since MCI guidelines would only bind the professionals, medical professionals, and not the companies. Now this is the explanation now is looking at the conduct of the person who is receiving the perquisite, and if these guidelines are and on that basis these so this would clearly cover such freebies which are given to the medical professional, and the amendment has been proposed to undo these judgments, allowing the claim of the taxpayer. Now another element of amendment which has been proposed is any expenditure incurred to compound an offense under any law in force in India or outside India. What was happening is that, and you may have heard that many companies, pharmaceutical companies, who have been dealing or selling their products overseas and were getting involved in certain dispute or litigation related to certain regulatory issues regarding the medicines they may have supplied there. So in those foreign jurisdictions, the companies would invariably settle their dispute, and then they would compound or settle the dispute. And the settlement, I may point out, normally specifically states that it comes without accepting or admitting the offense. So when the settlement happens, such settlement happens, and then the company would incur expenditure on such as compounding fee or settlement fee. This is on the basis that there is no offense has been either charged or has been admitted under any law of that country. So the courts, in fact, on that basis, have been holding that these compensation of paid on settlement in such matters was in fact a compensatory expenditure or is of compensatory nature, and therefore it would not attract, or it cannot be called an expenditure incurred in relation to any offense under any law. So it was for that reason it was not supposed to be disallowed invoking explanation 1 to section 37. So that by way of this amendment, that controversy is sought to be addressed, and going forward, possibly even such payments made on compounding or settlement of dispute, whether in India or outside India, that may attract disallowance. So maybe Mr. Vora may want to comment on this.
I think, to my mind, Neeraj, this will open up, several interpretative issues. Now, pharma companies, let us take that example. If they make available certain gifts, freebies to doctors, etc., Now, it will depend on the documentation, whether this is a business expenditure or it is meant to provide any benefit or perquisite to the practicing professional, and which the practicing professional is not obliged in law to accept, having regard to the MCI regulations or any other regulation governing the conduct of that professional. So here again, this is likely to be a gray area. This is going to be an area of dispute, whether this is in the nature of a benefit or perquisite. Now, with respect to the compounding fee, which you very rightly mentioned, it is without admission of guilt. You see, in foreign countries, they will enter into a settlement without pronouncing on whether or not there is, contravention of any law or there is an offense committed under any law. So it is short of conviction. So when you look at payment made to compound an offense, it would imply that an offense is established. If the matter is sub judice, if the proceedings are foreclosed as a result of the settlement entered between the parties, I don't think you can call it an expenditure to compound an offense under any law outside of India. So these are issues that will arise. And so far as the second limb is concerned, this benefit of perquisite, yesterday somebody was mentioning from a pharma company that this issue is actually pending in the Supreme Court at the moment, that whether this expenditure is deductible in the hands of the pharma company. So one really doesn't know what clarity.
Sir, basic question, should such a case travel to the Supreme Court in the first place? It almost like a trivial issue on freebies to doctors.
But Arun, the point is, the larger question. You see, the larger question, I have also argued a matter at some place. The larger question is that in terms of the law, there is a bar on the professional accepting a gift or a freebie, right? So you are now, that is not in contravention of public policy, unlike the Prevention of Corruption Act, where you disallow the expenditure also in the hands of the company. Here you may say it is opposed to moral policy, that you are making as a private pharma company, you are making available gifts to a practitioner in order that he can prescribe the medicine that you manufacture.
That is falling foul of MCI rules.
Yes. No, so for the individual, it is falling foul of MCI regulations for the individual who is governed by the MCI.
For the doctor.
For the doctor. But so far as the pharma company is concerned, they are not governed by the MCI regulations.
Very
you
well
may
said.
say it is morally wrong.
And so which way have the high courts weighed in?
No, high courts are also divided. Bombay High Court is in favor of the taxpayer, holding it to be a deductible expenditure.
Okay. So there are a couple of questions for you. One, Rohit, I'll come to you as well. Please share your views on patent infringement settlements done overseas by pharma companies on this one.
I would, no, if there is a patent infringement, it's a private party dispute, I would think. One party is alleging patent infringement by the other party. It's a private arrangement. Now, whether in that situation, can you say it is an offense under any law? I doubt very much. So we will have to expound the meaning of this word offense under any law. This is not an offense. It's an infringement that one party is claiming vis-a-vis the other party who's the owner of the patent.
Class action suit settlements, sir?
I would think that is not for contravention of any law. You look at the Satyam case for that reason. You see, the Satyam case, from what is reported, the class action suits, and there are judgments where, compensation was awarded, and the issue in the Indian courts and the authority for advance ruling arose as to taxability of those amounts. Now, clearly in those cases, the action was that they fudged their numbers, which led investors and induced investors to invest in Satyam shares or their ADRs. Now, there is no offense, or you can say that, furnishing false information is an offense under the US Securities Exchange law or whatever be the applicable law. But they are not convicted for that reason, and there is no conviction that has happened. The class action suits have been settled before a conviction could happen. So I would think that here this is an area which will lead into disputes relating to interpretation and having regard to facts of a given case.
I think, sir, one question which Mr. D. Ashok of ITC has put: if supposedly this amendment is meant to, discourage the settlement, so are we not putting a deterrent to a person who is, getting into a settlement rather than incurring fees legal fees on in a long run better, and then ultimately, settling, ultimately winning it. It's basically the businessman usually takes a call whether he wants to, get into a protected litigation or settle it without admitting a guilt. As you rightly said, merely entering into a settlement without admission of any guilt doesn't mean that there is an offense which has been proved against the taxpayer.
Right.
So therefore, in that situation, when it is only a consent, with the consent of the other side, without the admission of the guilt, if some amount is paid, it actually should not be in the nature of the disallowance in terms of the explanation also.
Right.
Because if you refer to all those FDA guidelines where pharma companies usually pay consent amount to the FDA authorities, that order specifically says that this is without admission or without proving that this is a case of the violation of any law.
I think
so
somebody
this will be a deterrent to people settling the long run battle.
Somebody put a comment in the chat box that infringement of patents could amount to violation of the competition law. Now, without going into that larger issue, the point that I'm seeking to make is that courts will then have to get into the nature of the dispute. You will have to look at the question whether the dispute amounts to violation or an offense under any law. So when we litigate in the tax court, you will have to actually get all the papers. You may have to get the suit, you may have to get the plaint, you may have to get the...
Yeah, so someone yesterday did try to expound that that a settlement may be akin to a plea bargain. I saw it on
you're right. You're right.
So actually, just to add there should be there is a distinction between compounding of an offense, which happens only when one has proved guilty under any law in force, and the settlement. The explanation does not use the word settlement. So settlement is even
a settlement could be like the SEBI consent plea, the consent, something of that sort. And you're saying that a violation is compounding like what we do in RBI, which you are saying is clearly a violation.
Correct.
So violation is that compounding will be post the guilt being established.
Yeah.
Or guilt being admitted, if not
admitted. Okay. Let us say guilt being admitted. Okay.
Correct.
And in fact, an interesting live example is supposedly there is a doctor and he's an optician and they allow a company which is selling all these spectacles at his premises, and the amount is paid to him as rent, but actually the rental is given is more than the fair rental. So whether part of the rental can be attributed to him in the form of a freebies, and therefore a disallowance can be made in terms of explanation. And all these issues will come up.
It is already giving tax planning advice.
Rohit, let me put it to you differently. Let us say a doctor has been found guilty of negligence and he is fined by the NCRDC, the National Consumer Forum.
Yeah.
Now he has to pay compensation, or the hospital has to pay compensation.
Yes.
Now in that situation, this medical negligence, can you say that the payment is made for an offense under any law? I'm not sure.
Should not be, unless it's a clear case of negligence.
And so what if this gets
negligence
reversed?
Is established. Negligence is established.
And Ajayji, what if it gets reversed? Ajayji, Rohit, in the appellate process, let's say the MCI guilty verdict gets reversed at the appellate forum or the Supreme Court, High Court, whatever. Then what happens? So later on?
Correct. Then whatever is the court decision, ultimate decision of the court, that
I think, Arun, what you said is, we have a live example. It comes to mind. This judgment has just got reported. Rohit and I lost the income tax case for a gentleman against whom there was complaint against under MCI. Now the MCI complaint subsequent to our losing the income tax battle has been quashed against that gentleman.
Okay.
Now, actually, he put an end to the matter. He did not want to litigate any further so far as tax is concerned. But since under the MCI proceedings, the charges were much more serious and penal, he succeeded in that. So as you said, you may have situations where the verdict gets reversed in a subsequent forum.
Fine. An interesting question, sir. 20 seconds. Is MCI the authority to establish the offense of the tax authorities?
No, MCI, the relevant regulator. The relevant
Perfect.
regulator. Right.
Perfect.
So moving on to next amendment, and I'll just quickly finish this amendment. This is disallowance of dealing with disallowance of interest on loan and borrowings, etc., which is allowed deduction on payment basis. So there is there was an explanation to section 43B, which provides that interest in respect of loans or borrowing which have been converted into a loan or borrowing or advance shall not be deemed to be to have been actually paid. Courts have earlier held that if the interest amount is actually converted into loan or borrowing, then it would amount to constructive payment. So on that, for that reason, this explanation was incorporated. Now, Supreme Court recently has, in one case, has said that when the interest is converted into a debenture, that would not get covered by this explanation, and that would amount that would be treated as amount actually paid. This is the judgment of MA Technologies. So in order to address this, the amendment is being proposed to incorporate even debenture into this explanation. So if any interest, unpaid interest, is converted into a debenture, that would not get allowed deduction on as on a payment basis under section 40, and would be disallowed under section 43. So
Neeraj, I just want to come in. I think this is a subject close to my heart. I was arguing this matter, almost 15, 20 years back, and I was had couple of hearings before the Madhya Pradesh High Court at Indore, and almost on the verge of winning when this first amendment came, that if the interest is converted into loan, it will not be treated as payment. Now, this question of debentures, the recent Supreme Court judgment, which has sought to be overruled by this proposed amendment, again, I think will create a lot of difficulty. Today, bankers are willing to settle and enter into this settlement with borrowers, where the borrower is not in a position to pay the outstanding principal and the interest. They agree to take up equity, they agree to take up debentures of the borrower in order that over time they can recover. Now, this I think is a dampener so far as settlement of these outstanding liabilities are concerned, because the borrower will never get deduction for this interest. So once he converts this into debentures, he would be paying interest on the debentures, which will be a different form. You will never get deduction for the principal amount of the debenture, which is actually representing outstanding interest. So frankly, I really don't understand the rationale for these kind of amendments, when actually the assessee should get deduction for the interest that is outstanding, which is discharged in one form or the other. So I thought I'll just make these few comments on this.
So I would tend to agree. I think this is some kind of a tax overactivism. Actually, the one is seeking to plug any kind of loophole without looking at the maybe the larger picture. So now this new scheme of taxation of virtual digital asset. This is section 115 BBH is sought to be incorporated under the tax laws, which will provide for the code or a scheme for taxation of these virtual digital asset. So virtual digital asset, commonly we know as crypto, and I'm kind of avoiding using the word currency. So they have become fairly popular, and trading in these trading volumes in these virtual digital assets have increased manifold. In fact, the present total market cap world over is 1.66 trillion USD, out of which say one single virtual currency or Bitcoin, its market cap is USD 710 billion. And Wazir X, which is India's largest cryptocurrency exchange, their annual trade has an annual trade of over 43 billion during the last year, 2021, financial year 2020. So this is the kind of number or volume or transactions one is talking about, and you can imagine the kind of tax which was possibly the government was losing if they were not taxing such transactions in the past. So in order to address this, the finance bill has proposed a scheme, a new scheme for taxation of such VDAs. Section 115 BBH provides for taxation of any income arising from transfer of any VDA at the rate of 30% plus surcharge, etc. And then subsection 2 says that while computing or taxing such income, no deduction in respect of any expenditure shall be admissible. No set-off of loss shall be allowed to the assessee in respect of such transfer of VDA in respect of from computing income in any other head. Say no set-off of loss from transfer of VDA is allowed against income computed in any other provision. And of course, loss on transfer of VDA shall not be allowed to be carried forward to the succeeding year. So no loss is allowed to be set off while computing income from transfer of VDA. But interestingly, and maybe it may be subject to correction, if there is a loss in one transaction of VDA and there is a income or profit in other transaction of VDA, possibly that loss can possibly be set off inter se against the profit earned from another transaction or income earned from another transaction of VDA. That is what it appears. And that may be possible. VDA has been defined and naturally in a widest possible terms to include any kind of code, number, or token, which can be transferred or traded electronically. So without going into the definition, central government may notify or specify any other non-fungible token. So here what is happening is, apart from taxing the income, the legislature or the finance bill provides for deduction of tax at source at the rate of 1% from any transaction of payment for transfer of VDA. So for any payment, the payer, I would say, payer would be responsible for deduction of tax at source for any transfer, any payment which he makes for transfer of VDA. So here it may be also noted that where the transaction is not happening in cash or the payment for transfer of VA is undertaken in kind, or say in exchange of another VDA, and the cash is either not cash element is either not sufficient or it is not there at all, then the payer himself has to pay tax and ensure that the tax on such consideration before releasing the consideration, he has to ensure that tax on such transfer or such payment has already been has been paid by or deposited in the government treasury. Subsection 3 provides for some basic exemption of which is 50,000, where 50,000 and 10,000. And then this transaction. So the board is proposed to issue guideline, is supposed to issue guideline with prior approval of the government to remove any difficulty arising in giving effect to the transaction to the provision of section 194S. You see this this provision or the of the board providing board issuing a guideline for removing difficulty is very significant, because this is a nascent provision in dealing with the a kind of such kind of high transaction. This is a nascent provision of law, and the one would find many difficulties in implementing even this provision for deduction of tax at source at 1% of 194S. Under section 194S, it is very difficult to implement, and I'll just in a moment I'll just try and explain. You see, when one is dealing in a crypto currency on a exchange or on a platform, say Wazir X or whatever, the basic premise in a crypto currency for a cryptocurrency is the privacy. So when a person is buying a cryptocurrency, he does not know who is the seller. He just goes on the platform. He'll in whatever manner, whether he pays in cash or he pays in exchange or out of his wallet, he would get the other VDA or VDA currency which he is seeking to purchase, but he would not know who is the recipient of that amount, or from whom, or who is the seller of that that VDA. So the issue is how one would give effect to section 194S, how the tedious compliances would be undertaken when the payer, the recipient itself is not known. So this is a similar situation where on the stock exchange, whether it is NSE or BSE, one would not know who is the seller, or to whom with whom one is transacting, and that's possibly the reason that security transaction tax is charged on such transaction. So as of now, as of today, I don't think the one would be able to implement or undertake compliance of section 194S unless as the government were to come out with some guidelines as to providing for the precise mechanism. The issue would arise as to whether the recipient, the platform would be treated as the recipient of the amount, or as to these guidelines have to come in. Otherwise, one cannot possibly proceed and deduct or undertake compliance under section 194S. So that is one big difficulty right now, and one would have to wait for the guidelines to implement this amendment. The second issue which we see is that at what price one would at what value one would deduct tax when one goes on a platform and transact. The price transaction is undertaken at a particular price. The rupee value may, or dollar value may reflect, or one can see at that point in time that what is the value of that particular asset or VDA. And if one may try and transact either in cash or by way of payment of VDA. So one would, but that's all that value or price is fluctuating all the time. So instantaneously that price may keep changing. So which price is to be taken for or value is to be taken for undertaking deduction of tax at source, or for that matter paying tax So this is and assessing officer would always dispute that the price with reference to which you have paid tax or deposited tax, then that was not the correct price. So these things need to be clarified in terms of the guidelines which one can await. So this is another issue which I may just point out is about.
Neeraj, most questions are on these reward points. I think people have lakhs and lakhs of reward points, and that's the question on the chat box also. Reward points ka kya hoga?
I would say that reward point, if you look at the definition of VDA itself, I don't think it gets covered into this. You see, it should be an information or code or number or token generated through cryptographic means. So I would not, I don't think rewards from points would be generated through cryptographic means. Providing for a digital representation or value exchange. Reward points are calculated with reference to the value of a particular transaction. So X percentage or whatever is the rate which is attributed to the reward. On that basis, the reward is reward entitlement is credited. This is not a any code or number generated through a cryptographic means. So I don't think that would attract this. That would not get covered under VDA. That's my understanding. So
I would also tend to agree. And then the question is, when you redeem your points, there is no transfer in that sense.
Yeah.
Although the definition of redemption of transfer includes extinguishment. But when you are redeeming your points, I don't think this is meant to be covered within the definition of virtual digital asset.
So further, in order to tax or cover the gifting of VDA, so corresponding amendment is proposed to be made in clause X of subsection 2 of section 56, and this VDA is included in the expression property. So any gift by way of VDA would also get covered under section 56. So this is I think I have taken more time than what I was allotted.
I think, Neeraj, there are many questions on the issue of set-off of losses. So the issues in the chat box is what will happen to the losses of the earlier years, which may have been carried forward, whether those losses will be available. The second issue, which probably many people have raised, is under which head of income this income will be assessed, and whether within the same year the losses can be set off.
You see, as I said, the provision is clear and sweeping. Subsection 2 of section 115 BBH. It says no set off of any loss. So any loss, whether present or past, carry forward or otherwise, there is no set off of loss which shall be allowed while computing income from transfer of VDA.
No, I think let me give a twist. Let me give a twist. I am assuming that somebody is identified and is holding a VDA and has earned a loss on transfer of the VDA in the last year. Now the point that is being made, it may not be allowed set off under 115 BBH, but it can certainly be allowed to be set off against his other business income. Suppose it's a business loss or it's a capital loss. It may not be allowed in this year against income from transfer of another virtual digital asset, but against his other income that would have been carried forward in terms of the relevant section 72 or 74 or whatever be the applicable section. No, that cannot be taken away. Huh?
In fact, if you see the language of section 158 BBH also, the clause B says no set off of loss from transfer of virtual digital asset computed under clause A.
Right.
Of subsection 1 shall be allowed against income computed under any other provision of this act.
No, for that year. So for the past, for the past under 72, 74, you are carrying that forward. So that you can claim not under 115 BBH, but you can claim against your other income.
I would
And
say
this is, sir, only regulating the loss from virtual digital assets. So supposedly if I have loss as well as income from VDA, why should that not be set off? So if there is an income as well as loss in the same year.
That I think that bar, you see this bar under 2B.
It says under any other provision, computed under any other provision. Loss computed under.
no. So this provision itself has come in from this year. So if from a virtual digital asset which a transaction was undertaken last year, when this provision was not there and there is a loss which has been incurred, so that is open for set of.
No, that of course, I think Rohit's question is so far as the loss incurred in this year on transfer of one BDA versus
against another.
That is the same year.
That is possible. That is possible.
That I think is possible because this is like a speculation income and loss. In speculation, we can only set off speculation gain against speculation loss. So there is no reason why the VDA income and VDA loss cannot be set off.
Right.
What it says is you cannot set off the VDA loss against income under any other provision.
Right.
So therefore, VDA loss cannot be set off against maybe any other capital gain. VDA loss cannot be set off against any other business income. But probably within the same, it may be set off.
This is what I was earlier also mentioning that
within the same year can't be carried forward.
Yeah, it cannot be carried forward, but within the same year, it can be set off. VDA loss can be set off against VDA income. There is no such restriction of bar.
So the CBC chairman has clarified कि नहीं हो सकता है. But of course, we have to read the law, not what the CBD chairman necessarily has to say about it.
No, so what are we saying that on the profit you pay tax, on the loss we ignore the loss?
Yeah.
That according to you is the revenue's interpretation.
Yes.
Yeah, that is the revenue's interpretation.
Within the same year also.
Yeah, that's what he's saying on the same year.
They are saying no set off at all.
Though this will become like a black money. All credits are taxable, no loss is allowed.
Correct.
Right.
Yeah.
I think Rohit, you can take it forward.
Largely, Ajay ji, you are satisfied with the drafting because this is going to come with a lot of circulars, lot of notifications, and industry. You will have a separate industry now which will thrive on
I
this
think,
VDA.
Arun, you have to give it to the government that this is nascent legislation. In fact, we are all grappling in the dark at the moment. You see, I don't think the contours of this are defined. We were still struggling with the legality of crypto. And that is still, the subject matter of the
it's
RBI.
up in there. Yeah,
Sorry?
it's up in there.
It's up in the air. So I think while that is being debated, discussed, maybe legislated, the government thought that they would be losing revenue from this trading that's happening or of crypto. So I think we brought in the law. The law will have to keep pace and will have to undergo legislative changes over time in order to come to grips with what the world is actually moving to.
So
I think the only question here, I'll close this, Neeraj ji, this part. But since this is very, very important and has huge ramifications, the definition too is quite expansive, sir. We read it yesterday also at another panel. It's very expansive.
I think the idea is to make it all comprehensive at the moment so that to see that nobody slips out of the sieve. But I think I would like to emphasize the point Neeraj made about TDS. You are placing an almost impossible burden on the taxpayer to say that you must withhold tax under 194S. You are not able to identify who's the person. And clearly, somebody raised the question about whether the platform is liable. I would say the platform is only a facilitator. The platform will say that I am only providing a marketplace where, the buyer and seller are coming together. I am not responsible for deduction of tax at source unless you put in something like an STT that Neeraj also mentioned. So here it is almost impossible to comply when you don't know who the seller is. And as he said, how do you quantify? There are, myriad situations of trying to determine the income and the component of tax that you need to withhold. How do you quantify? What rate do you apply? He's put several such situations and examples. Those
Yeah,
are
and
live examples, and they will arise in everyday life.
And what if you're partly resident in a year in a foreign
All
country,
those issues will arise.
where you then you invest in those exchanges and so on and so forth.
And different platform would show different rate at a particular.
Right. I think this law will have to be, dynamic, in the sense that the government must keep coming out with circulars, clarifications, or make legislative changes wherever required.
So one of the jokes doing the round today on Twitter is, sorry, I spent some time on Twitter. You may think that I'm a Twitter addict. But one of the jokes is Gutka pay 28% tax and crypto pay 30%. So there is a lot of backlash against this 30% tax, which means a huge percentage of this populace or a good chunk of the populace is invested in this space. And they're saying 30% is excessive.
No, but
it was trending on Twitter yesterday.
The number that Neeraj has thrown out, it is huge. It's a tall order that.
So 30%, sir, excessive lag raha hai aapko?
I think basically, as we discussed yesterday, they have equated this to an illegal activity. That gains from an illegal activity, because the government is not in a position at the moment to take a stand whether to legalize crypto or to say that this is illegal. So you have placed it at the highest rate of 30%.
They've equalized it with a game of chance, like horse racing and kaun banega crorepati.
Or even smuggling, for that matter. You are not allowed any deduction for expenditure. You are not allowed to set off the loss from an illegal activity.
Sir, what's the latest controversy for all the people going around? A regulatory quagmire can always upend an entire industry. Karnataka, Madras High Court quashed the Tamil Nadu government's diktat, which said that all these fantasy cricket leagues like Dream 11,
right.
It said that they had outlawed it in Tamil Nadu, and the Madras High Court struck it down. So the question again comes, Karnataka then government said that we will levy a tax on this and that, and this activity cannot be performed in Karnataka. Question is fantasy cricket league a game of skill or a game of chance? Some of these things, I just wonder, when will our government really wake up? Can't you see that crores and crores of people are playing fantasy cricket league? Instead of just accepting that this is the norm, this is the reality of the day.
This is the reality.
We are still arguing whether it's a game of chance or a game of skill. Some of these debates had to be settled 40 years back, and we are relitigating them now right up to the Supreme Court.
Right. I agree with you.
But do you believe in chance or skill?
I think you need to have skill and a lot of luck on your side.
So just quickly, I'll point out two small amendments. There is amendment proposed under Section 68 to provide that source is required to be approved by the taxpayer in respect of loan, in respect of any credit in the form of loan, borrowing, or any other liability which is credited to the books of account of the assessee. This requirement was earlier only was in respect of shares credited by way of share capital or share premium or share application money in terms of the proviso to Section 68. So that is loan, etc., loan, borrowing, or any other liability credited. The onus now is on the taxpayer to also establish the source. And then there is an amendment proposed for denying set off of loss in respect of income discovered in such cases. This is in line with other similar provisions. So Section 79A is sought to be incorporated to deny set off of loss in respect of income which are discovered in such cases. Similar provisions is already there in respect of income under Section 68, 69, etc. So on the same parity, this is. So Rohit, you may start.
Thank you, Neeraj sir. I think I'll just quickly say a few words on these two slides also on this issue of Section 68. I think when the issue of source to source was only limited to share application and share capital, was there was a logic. The logic was that money comes to you, they become a shareholder in your company. So therefore, you can at least request a shareholder to give the source and source of his money. Now that has been extended to the loan also. In fact, someone today jokingly asked me, so I go with a borrowing for the purpose of borrowing. For example, in Ludhiana, many people borrow money. So I go to someone in order to borrow the money, and I tell him that apart from giving the money to me, lending the money to me, also give your balance sheet, also give your income tax return, also give your financials. He will say, I will neither give you financials, I will neither give you ITRs, I will also not give you the money. So this actually is a dampener for an industry which works substantially on borrowings. And why the courts were making a distinction as to the onus of proving source to source in case of loans and borrowing was the money was ultimately repaid. So if it was really in the nature of an accommodation entry, which normally the department alleges in case of section 68, why would I repay the money back to the lender? So that was probably the logic for not putting the onus of establishing source of source. I think to this extent, it may not be a welcome amendment from the industry perspective, which very heavily relies upon the the financial borrowings from sometimes unorganized sector and sometimes from organized sector also. On the issue of the set-off of laws from such cases, in fact, the reason why this amendment has been made is many times. So, just to give an example, supposedly during the course of search, parallel books of accounts are found, which reflects that there are certain sales, there are certain purchases, and which has resulted in an income. Now, what people used to earlier do was they used to set off that income, which was found during the course of search, and which was treated as undisclosed income against their normal losses. While section 68, 69 and 69A additions were not eligible for any such set-off, there was no specific provision in the context of these kinds of business income being set off against the existing losses. So this amendment which has been made is primarily to prohibit the set-off of such losses. So these are in fact some of the important amendments which have been made. Now moving on to the topics which have been assigned to me. The first issue is the amendment on goodwill. Now, goodwill, basically, the amendment is more in the nature of a clarification in this year. This issue was actually very close to the entire industrial fraternity, the professional fraternity. And this amendment was made in the last year in order to provide that no depreciation will be admissible to goodwill. Neeraj, we can move on to the slides. So the last year the amendment was made to provide that there will be no depreciation will be available to the goodwill. The amendment was made primarily to overrule the decision of the Supreme Court in the case of Smith Securities, which was in the context of amalgamation and the amalgamation resulting in goodwill. Now, in case of actual any business acquiring any person, any businessman acquiring a business, and excess consideration being paid, which was towards the goodwill or towards various intangible assets, were categorized as goodwill in the books of accounts. Now that goodwill may comprise of various intangible assets, and a compendious name of goodwill was given to one. But somehow the amendment was made in the last year to categorically provide that no depreciation will be admissible to a goodwill. The amendment this year is basically in the nature of a clarification to provide that if you reduce the goodwill from the block of assets, which is actually the mandate of law also now, if you reduce the goodwill from the block of assets, in that situation, it will be deemed to be a transfer. Now, on this slide, which you will find, which is there on the screen, this is the formula which is given in order to compute the capital gain at the when you will reduce the goodwill from the block of assets. So it will basically be part of the section 50 provisions. Supposedly you already have the assets near the last slide itself. If you have the WDV, so for example, the WDV of the intangibles is 1,000 rupees in the near the last slide, 1,000 rupees, and the actual cost of assets other than goodwill which you acquire is 1,500, whereas the goodwill which you are required to reduce is only 200 rupees. in that situation, the remaining only on the remaining amount you will be eligible for depreciation. Now, if you see this next slide, the issue of capital gains will arise only in a situation where the block cease to exist and the amount towards goodwill is more, or in a situation, in these three situations, where the actual cost of the goodwill is say 200 rupees, then in that, and the block is 1500 rupees, then there is no capital gains. If the cost of the goodwill is say 1000 rupees, whereas your block is 700 rupees only, in that situation, there will be a resultant 300 rupees of capital gains. Now, the amendment is clarificatory in nature, that will be treated as deemed transfer. Now, we can move on to the next amendment, which I think is an important amendment in the context of succession to business. Now, as we all know, section 170 of the Income Tax Act, near the next slide.
Rohit, on this goodwill, I have a small intervention. Actually, you see, while this goodwill, if this amount, there is a change in the amount of goodwill in the block, then it has been made taxable as capital gain. My basic question, in fact, on principle is that what is happening is that goodwill, for instance, earlier it included other assets which were otherwise depreciable, intangible assets, and the amount reduces if you segregate those item of intangible assets which were earlier you were showing as part of goodwill, and claim depreciation on it. Say, for instance, earlier goodwill was shown as 1000 rupees, and then you bring it down to 300 rupees, and 700 rupees 700, which represented other intangible asset which are otherwise depreciable, you segregate. So goodwill comes down from 1000 rupees to 700 to 300 rupees. So it means that it will become one would become liable to short-term capital gain under section 50 to that extent. This is what the amendment is.
In fact, this again is a controversial issue, whether or not you can bifurcate the existing amount of goodwill into various various intangibles and only exclude the amount of goodwill after retaining the amount of various intangibles. So as you explained, supposedly in my books of accounts as of now, I have 1000 rupees of goodwill. But that 1000 rupees of goodwill actually includes 700 rupees of various intangibles, which is already included as part of the goodwill. Now, the law only mandates that depreciation is not admissible on goodwill. So whether I will be excluding only 300 rupees or I will be required to exclude the entire 1000 rupees. This again is I think is a controversial issue, whether which amount is required to be excluded.
Secondly, actually, if there was to be a levy of tax as short-term capital gain in respect of this reduction in the value of goodwill, so what I would say is that where is the income being taxed? What you are taxing is amount reduction in the amount of goodwill. There is no income per se which is supposed to be taxed as short-term capital gain. While tax, the legislature is empowered to levy tax on income. So there is no income which is here which is to be taxed, which is supposedly being taxed. It is in fact there is not an income at all which is contemplated. Even if one were to be saying that this is an anti-avoidance provision or something like that, in every other anti-avoidance provision that we have, whether it is transfer pricing or, for instance, where you determine the income component in the transaction with reference to arm's length price, or you determine income with reference to a fair market value or etc. in other cases. This is one provision or amendment provision which I see where what is being sought to be taxed is not income, but an amount of reduction in goodwill. So whether it'll be constitutionally, it should be possible, or that's the fundamental question that I was seeking to raise.
No, you have a valid point. In fact, what we are doing is only making the adjustment into the WDV of the asset because of the mandate of law. There is actually nothing, no consideration which has been received, no amount which has been received. So there is actually no income which is resulting in the hands of the assessee. You are right.
There is no transfer, there is no gain, and still you are taxing it as a short-term capital gain. So that's a fundamental issue, I think.
Correct. So I think let's move on to the next issue. We have a lot of slides to cover, and there are some very interesting issues which are going to come. Now the next issue is, this is partly, I would say, in the nature of a clarification, this amendment, and partly in the nature of diluting the principle of Maruti Suzuki, which was argued by our chambers only. As we all know, in the case of a succession, section 170 kicks in case of business organization, and it provides that income relating to the period up to the date of succession is taxed in the hands of the predecessor, and income relating to the period after the date of succession is taxed in the hands of the successor. Now, in the next slide, you will find that what we have pointed out in case of amalgamation, what basically happens is that two companies merge. There are 2 or 3 dates which are relevant. Normally, in the scheme of amalgamation which we provide, the appointed date of amalgamation. The second date which is relevant is the date on which the court approves the scheme or the NCLT approves the scheme. The third date is the date on which the order of the NCLT is filed before the ROC and the amalgamation schemes comes into operation. Now the law, fairly well settled law as per various judgments in the slide number 52 is that on the date on which the copy of the NCLT order is passed with the ROC, which we call as an effective date, the predecessor company or the amalgamating company ceases to exist. In that context, the law was that after the date of the scheme of amalgamation becoming effective, any order, assessment order, which may be passed by the assessing officer in the hands of the amalgamating company, which ceases to exist on the effective date, that will be invalid, because then you will be passing an order in the hands of a non-existent entity. That is the principle which has been laid down by the Supreme Court in the case of Maruti Suzuki. Now look at a situation where the order of the scheme of amalgamation is effective on, say, for example, in January 2022. The department usually says is that January 2022 may be the date on which this order is effective, and the company may have been struck off and may have been dissolved in terms of the amalgamation scheme. But we were not aware of the order of the amalgamation, and therefore any order which is being passed by us, any assessment order which is passed by us, even during till the time you give us the intimation about the amalgamation, that cannot be regarded as invalid. And one of the arguments which was usually taken to support that contention was A, that we were not aware of the amalgamation scheme. Second, what are we taxing is the income relating to the predecessor when prior to the date on which the succession takes place. In fact, in the context of individuals, the Delhi High Court in multiple judgments have held that the assessee pointing it out to the assessing officer as to the date of death is irrelevant. Once the person ceases to exist, any assessment which is made in the hands of a dead person is invalid. That's the law which has been laid out, said intimation is not relevant. Now, what the amendment which has been proposed, if we go to the slides, now in this background, if we see the slide 53 or 54, now the section now says that in terms of section, near the section 53 slide number 53, where the pendency, the word pendency has been defined. Now what they have done is they have defined that any order which is passed during the period of the pendency of the business reorganization, that will not be regarded as invalid. That will be regarded as an order passed in the hands of the successor entity. So for the pendency has been defined near the 52, slide number probably 52. Or maybe prior to this. Yes. So they have defined the word pendency to mean period commencing from the date of filing of the application. And if you see the last highlighted verse, it says is received by the principal commissioner or the commissioner, which means till the time the scheme of amalgamation is intimated to the principal commissioner or the commissioner, any order passed till that date will be deemed to be an order passed in the hands of the successor entity. And to that extent, they have diluted the principle of Maruti Suzuki, which says that any order passed after the effective date will be invalid. So to this extent, this partly is in the nature of a clarification that it recognizes the well settled principle. Then any order which is passed till the date the scheme is effective will always be a valid order, and any order passed after the effective date will probably, in case it is passed in the hands of the amalgamating company, will be an invalid order. So we have explained with the help of this observation or the example. Illustratively, say for example, 2nd April 2022, the NCLT order is passed and the scheme is intimated to PCIT on 2nd July 2022. So if the assessing officer passes any order in May 2022, now in May 2022, the amalgamating company ceased to exist. Logically speaking, applying this principle of Maruti Suzuki, this order should be invalid. Now what the amendment says is, since you have intimated to the PCIT on 2nd July 2022, this order which is passed in May 2022 will be deemed to be passed in the hands of the successor entity, and therefore probably it will not be hit by the principle which has been laid down by Maruti Suzuki. So this is in substance the amendment which has been proposed. Neeraj or Amit, Mr. Vora, you want to comment anything on this? Because Maruti Suzuki is a judgment which is argued by you only.
I think you explained it lucidly. So basically, there are some judgments which have come in subsequently where they have said that if the assessing officer is intimated of a proposed scheme of reorganization, since the income tax department has to file objections to the proposed scheme of reorganization before the NCLT, they have due intimation of the reorganization. So there the tribunal benches have taken a view that no further intimation is necessary. Now this amendment will kind of nullify those decisions of the tribunal, that until the commissioner receives an order or receives a copy of the order, any assessment made during the interval of the filing of the reorganization scheme until the time the commissioner receives a copy of the order would be treated as an order made on the successor company and hence valid in the eyes of law. So I think you put it across clearly.
All right. So let's move on to the next. Next is a very important amendment in the context of business reorganization. Now, as we all know, there is always a huge interval between when we file the scheme and till the time the scheme is approved. As we highlighted, applying the principle of Marshall and Sons, the post the appointed date which is fixed under the scheme, all acts which are done by the successor entity or the amalgamating entity are treated as all actions, all incomes and assets belonging to the amalgamated entity on and from the appointed date. That's a very fundamental principle laid down in Marshall Sons. Now, what usually happens is, say let us take an example. 1st April 2021 is the date I mentioned in my scheme of amalgamation as the appointed date. I filed the scheme of amalgamation, say in September 2021 in the court, in the NCLT. Ultimately, because of COVID and other various reasons also, it takes time for the scheme to get approved. Say, for example, the scheme gets approved in November 2022. By that time, the time for filing the return of income, because all incomes relating to period post 1st April 2021 will be deemed to be income of the amalgamated entity. So it will have to be considered as the income of the amalgamated entity. In between, say for example, in July or August, I am supposed to file my return of income. And in July and August, the NCLT order has not come approving the scheme of amalgamation. So technically at that stage, there are two companies which are legal entities. One is the amalgamating company and the other is the amalgamated company. In that situation, I will file my return of income. Later on, when the scheme is ultimately approved, I am required to file a return of income in order to give effect to the amalgamation scheme. Not the practical difficulty which usually arises is, by the time the scheme of amalgamation is approved by the NCLT and it becomes effective, once I file a copy with the ROC, the time limit for filing the revised return or even the belated returns gets lapsed. So therefore, there is no, and as we all know today, in the e-filing schemes, everything has to be filed online. So there is no way, if the portal does not permit to file a revised return or a belated return, I cannot file a revised return in order to give effect to the scheme, because from 1st April 2021, I have to consider all incomes in the hands of the amalgamated entity. So this was always a catch-22 situation as to what the amalgamated company should do in that kind of a situation. Practically what we used to do was, we used to go back to the assessing officer and tell him that, look, there is a specific provision in the amalgamation scheme itself which enables me to file a revised return of income. The portal is not allowing me to file a revised return of income, and therefore I am filing it physically in order for you to give effect to it. Usually the assessing officer, in the absence of any statutory mechanism or the statutory provisions permitting him to take cognizance of such return, was unable to give effect to that provision. In that context, there was a judgment in the case of Dalmia Power which came, which says that the department is bound to give effect to the scheme of amalgamation, and the scheme of amalgamation, if it provides or entitles the amalgamated entity to file a revised return, the department is bound to give effect to bound to process that return of income. Now, what section 170, by this section 170, what it proposes to do, which is a new, very welcome amendment in the context of business organization, is it now gives statutory recognition to the right of the amalgamated entity to file the revised return of income in order to give effect to any such scheme of amalgamation or any business organization for that, business reorganization for that matter. So what it says is, it says that notwithstanding the provisions of section 139 of the IT Act, which provides for the due date for filing the income tax return, the new section is proposed to permit filing of the modified return by the successor company in case of business reorganization up to the receipt of the order of High Court or tribunal or adjudicating authority within a period of 6 months from the date of such order. Now, this lines which we have highlighted is very important. Now, it specifically says that you have to file whatever return you have to file within 6 months from the date of such order. Now, in view of this amendment, it will become all the more important for the amalgamated company, or if any, in case of demerger, etc. also, if some revised returns have to be filed, it should be filed within this time. Because if the return is not filed within this 6 months period or the 6 month window which has been given, one, it may not be possible for us to rely now upon the Dalmia Power judgment to say, because the scheme provides that I should be allowed to file the return of income, because now the law itself mandates a particular time limit for filing the return of income. So I think this is a very, very important amendment which permits filing of the return of income in order to bring it in line with any business reorganization scheme. Sir, any comments?
Rohit, I have one question for you. While this permits the successor company to file a modified return, you will also need to modify the return of the amalgamating company or the predecessor company.
Yeah, so this is a very interesting issue which you have raised.
So therefore, both, I think both should be allowed to modify the return.
Yes, I think this seems to be an error.
Even in the case of a demerger, the demerged company will also amend the return to exclude the period post the appointed date. So I think this needs to be flashed to the government. This needs an amendment.
I think this seems to be an error.
Yeah,
I think you are right.
Not just the successor company, pursuant to the reorganization, modified returns will have to be filed by both the entities.
No, I think you are right. Absolutely correct. Both the returns have to be amended so as to exclude the income from the hands of the predecessor and also to include it in the hands of the successor.
See, technology has tied our hand, but I remember in the past there were cases where the amalgamation was approved almost 5 years down the line. And we filed revised returns, and even in some cases where the assessment was done, we filed additional ground before the Commissioner Appeals to give effect to the amalgamation.
Yeah, Ajay, I need to take leave to be on the panel in the next 10 minutes. So
Right.
I just, from my side, I have a question or two for Ajay. On the litigation management side, the thrust has been that the avowed intent is to reduce the litigation.
Right.
That's the avowed objective. Yet litigations only increase year after year after year after year. At every level, of course, the statistics may show something else, but still the cases only keep increasing as opposed to other jurisdictions. We still report a few transfer pricing cases every day. We've crossed 8,000 transfer pricing cases, and that doesn't go a week where we don't have at least 15 transfer pricing cases. Maybe Neeraj would know better because he reads the portal a little more, Tax Sutra. So I'm just wondering, Ajay, is there something fundamentally wrong? Yes, the updated return is there. Okay, but leave that aside. Don't we need to do a fundamental course correction to reduce that?
I think, Arun, I don't think we need any change in the law. Basically, I think it's the administration of the law which is giving rise to so many disputes. That's one. Second, I think because matters take years to settle, if the tax officer has taken a particular view and it goes all the way up to the Supreme Court, it may take 20 or 25 years before the controversy is settled. And in that space of the 20-25 years, you will have almost 20 assessments which will follow the same process. So therefore, it will add numbers at every level. So I think this proposed amendment in section 158 AB, to my mind, is very welcome, provided the department uses it and uses it profusely. We already have an existing provision of 158 AA, but it is sparingly used. I have not seen the department in any case using 158 AA. That was only in context of appeal to the High Court and Supreme Court. Now this is sought to be extended even to an appeal to the tribunal. And if you remember my comment yesterday, especially in cases that go before the DRP, now since the revenue does not have a right of appeal against the DRP, therefore the DRP records that a particular issue is covered in favor of the taxpayer by the decision in the taxpayer's own case, may be approved by the High Court. Department's SLP is pending in the Supreme Court, so therefore the disallowance continues to be made. Now, that is only to protect the interest of the revenue. If this is also taken care, then at least those issues will not travel to the tribunal. The taxpayer will not have to, file a stay of demand application to seek stay from the tribunal. So those numbers will come down, and even in the dossiers, the tax demand will come down.
Sure. So, sorry to interrupt. So, in the last 5 years, let's look at only the last 5 years, because a lot of bold reforms have been made in the tax law. Corporates who've been coming for opinion to you for more than a decade or so, have you noticed any change in their approach? Forget the administration. Have you noticed any change in the approach or in the mindset of the corporates who come to you for opinion? Have they been as aggressive as before, less aggressive, or more aggressive in their approach, in the planning?
No, I think corporates look at, I don't think that they are aggressive. They want to fall on the right side of the law. Nobody wants to circumvent the law. Nobody wants to, get into a case of evasion of tax. But at the same time, everyone will want to organize their affairs to pay the right amount of tax. So if there is a provision in law under which they can organize their affairs such that they pay the least amount of tax, which is justified, which is legitimate, I think corporates will fall for that approach. And now today you keep that in mind. You today also have GAR. So you have to be mindful of the fact that whatever approach you adopt must not again result in invocation of GAR.
On GAR, on first principle, I'll ask one question to Ajay. Very short answer, sir. That assuming that the 3 crore threshold, that a transaction looks a bit fishy, but it's below the 3 crore threshold of GAR. On first principles, would that transaction still be taxable under the McDowell doctrine?
No, the assessing officer can certainly take the view that this is a tax avoidance. He need not necessarily invoke GAR. I don't think his jurisdiction is taken away as a result of the GAR provision being incorporated in the statute. That will still be available. But I don't know, you may know better. I have not seen one case in practical life on invocation of GAR at the moment.
Yeah. Yeah, true. I think poem, we've still had some cases,
Right.
at least at the departmental collegium level,
Right,
and so
right.
on. And one in Ahmedabad, which we reported, which got quite a lot of traction. So,
Right.
yes. Ajayji, could I take your
Sure,
leave?
I think, Neeraj is there to, take it over from you. But thank you, Arun, for being here and being a support as always.
My pleasure. Ajayji, from my side, I want to hear your final words. In the next 12 months, which two clauses will keep you most busy, apart from the usual ones?
No, I think 14A definitely, Arun, I see a lot of litigation happening on 14A.
14A.
14A and maybe this section 37 read with that 194R, the TDS on benefit of perquisite. And even this VDA, for instance, I think I will wait for the law to play out and this being put into practice, but there will be several issues that arise.
If Ajayji were a cricketer, I tell you, the way he plays it out, he would have been an outstanding test match player coming in at 3 down.
Well, not a T20.
Not T20. because Ajayji likes to play it out. And one of my favorite cricketers have been the Waugh brothers, and especially Mark Waugh. His flicks were as sublime as Azharuddin. So Ajayji reminds me of Mark Waugh. Who used to come at 2 or 3 down in the Australian cricket team. Play it out, Ajayji says. his pitch and terrain are the courts where he's the master. Ajayji, what a pleasure it is always to moderate with you. And I'll take everyone's leave. My pleasure, indeed a privilege to be moderating this session. Neerajji, Rohit, thanks so much.
Thank you.
Pleasure was entirely ours, and you have been outstanding, wonderful.
Thank you, Arun. Thank you.
Thank you, Aruni. So moving on, I think the next topic is very close to Mr. Vora's heart, new section 156 capital A, which is basically to reduce the demand, to bring it in line with in conformity with the orders passed by any NCLT in terms of the IBC. I'll just first explain the brief background of this, and then maybe we'll have an interactive discussion on this, because this is a very, very interesting issue. And probably I don't know how many people are aware about this IBC provision. If I remember correctly, when this new IBC law came in and we internally debated it, there is a section 238 of IBC, which says that IBC provisions override all provisions. The provisions of IBC as a non-obstantive clause, which say that it overrides all provisions, all other provisions. Now, the issue which came up initially way back when these provisions came was, in supposedly a corporate debtor has undergone a corporate CIRP process, and it is taken over by a new resolution applicant. Now, in terms of the IBC law, there is a bidding which basically takes place. The corporate debtor is basically bid by various resolution applicants, and ultimately on the basis of the bid which is invited, the highest bidder actually comes in and becomes the new management and takes over the management of the corporate debtor. There is a waterfall mechanism which is provided in section 53 of the IBC, which says that whatever amount is received as part of the CIRP process and whatever is the bid amount gets distributed to amongst various creditors, which includes, of course, banks, financial institutions, various creditors, and also the government, and various statutory liabilities are paid in accordance with the mechanism which is provided under the resolution plan which is submitted by the resolution applicant. Now, once that resolution plan is approved by the NCLT, it becomes binding, and it becomes binding on all. In fact, section 31A of the IBC makes it very categorical that it is binding on all creditors, it is binding on central government, it is even binding on statutory authorities. It effectively basically means is, supposedly a corporate debtor has say 100 crores of tax liabilities which is due to it. Now that corporate debtor goes through the CIRP process under the IBC, and it is taken over by a new resolution applicant, and it becomes the new management. Now there is a concept of clean slate theory which has emerged over a period of time in the context of IBC, which says that the new management comes with a clean slate theory, which means whatever amount they bid for in order to take over the the management of the corporate debtor, their liability is limited to only that amount. They cannot be settled with any further liabilities, which may be even the statutory liabilities or any other liability which may arise. Usually what happens is, as part of the waterfall mechanism, since income tax dues falls below the secured creditors and various other creditors, usually they are settled at a very small amount. Say for example, if 100 crores of tax liabilities are there, income tax department may be settled at say 5 crores, maybe 1 crore, or maybe without any money being paid to the income tax department. Now the NCLT passes an order approving the resolution plan which says that against 100 crores of claims which are made by the income tax department, they are entitled to say 1 crores or say 50 lakhs of rupees. Now 99 crores is no longer payable by the new corporate debtor. Corporate debtor has taken over by the new management. From the department perspective, if you go to the income tax department and say, look, this is the NCLT order which is approved by resolution plan. As per the resolution plan, against your 100 crores of claim which you filed, you are entitled to only 50 lakhs of rupees, and balance 99.5 crore you write off in your books of accounts. The income tax officer will say, where is it? The provision in my income tax act. I will not accept your claim. I will pursue and recover 100 crores from you. So this was actually leading to a lot of litigation, in the sense that income tax department was pursuing, in fact the assessing officers were pursuing their demands, whereas in terms of the binding provisions of the IPC, the resolution plan, etc., they were bound to accept the settlement amount of 50 lakhs in our example against the 100 crores of liability. So what section 156 capital A says, it's a new and a very welcome amendment. It says that there is a new section 156A mandates that the assessing officer will modify and reduce the demand raised on account of any tax, interest, penalty, fine, or any other sum in the notice issued under section 156 as a result of an order of an adjudicating authority. Adjudicating authority under IBC is the NCLT, in conformity with such order, which effectively means once NCLT passes a resolution plan, so in conformity with the resolution plan, he will modify his income tax demands and he will reduce the income tax demands, and thereafter serve on a notice of demand specifying the sum payable, if any, which shall be deemed to be a notice under 156. So in my example, as I said, against 100 crores of liability, he will issue you another fresh notice of demand of only 50 lakh rupees. In terms of the resolution plan, you will pay 50 lakhs of rupees and you will be done with it. So this to an extent is a recognition to the superiority of the NCLT process, of the IBC process, and it takes and the write-off of the liabilities of the income tax department. Just Saksham, move to the next slide and then I'll invite Mr. Vora's comments on this. In fact, this is the judgment of Ghanshyam Mishra, which laid down the law that all old liabilities get extinguished in the IBC process, and whatever amount is payable is only payable in terms of the waterfall mechanism. And if you move to the next slide basically refer to various litigation which arose because of the department, which includes the income tax department, GST, other tax dues, who were still pursuing their demand despite the resolution plan being approved. And this is an UltraTech decision was the one which was one amongst the leading judgments, initial judgments, which were argued by Mr. Vora before Rajasthan High Court. I think, sir, I would put it to you just to give your inputs on this, because this is a very important amendment and very close to your heart.
So I think, Rohit, as you mentioned, this establishes the primacy of the IBC over the provisions of the Income Tax Act, on which I don't think there is any dispute. The IBC law is evolving and it is maturing, and to the credit of the Supreme Court, they have rendered several landmark judgments to impart utmost clarity with regard to the working of the IBC law. So as you put it, the Income Tax Department, along with other statutory authorities, is an operational creditor, which ranks lower in priority to a financial creditor. And the amount that is admitted by the resolution professional and which is ultimately approved by the adjudicating authority, which is the NCLT, is the amount that is payable to the statutory authorities for dues up to the CIRP commencement date. And thereafter, and all other dues have to be necessarily to be written off. Now, there were demands outstanding in the income tax record in their dossiers. Now, this 156A amendment allows the department to write off the amounts which are not recoverable. Clearly, they are not recoverable in law. They continue to be outstanding in their books. And it is for that reason that this proposed amendment will allow them to clean the books so that this amount is neither shown as recoverable nor do they pursue recovery for these amounts. So I think all courts today are following the principle laid down first in ArcelorMittal, which was followed this SR Steel, which was reiterated and followed again in Ghanshyam Mishra's case. So the position has, to my mind, been set at rest by the Supreme Court in these various matters. There are interesting issues that still arise, about the pending appeals. What do you do about the pending appeals? How do you carry forward losses of the corporate debtor? Those are all interesting issues on which there are still no clear answers. So I think we'll reserve that for a later discussion. This is not part of the budget discussion.
I think one interesting issue, which is a related issue, is, as you said, prior to the CIRP date, of course, there are differing views also on that, whether up to CIRP date or up to the effective date. So we will leave it that also. But what happens to the pending assessment? So this technically talks of the demands which are already existing, and those demands will be adjusted and reduced in order to bring it in conformity with the order of the IBC.
Right.
So an issue which an interesting issue which arises is a demand which has not arisen as of now.
Right.
But the assessment is still going on relating to the period prior to the CIRP date. Now that demand will crystallize at a later date. As per our understanding of the legal position, even that demand cannot be enforced in future.
Right.
So does that mean that in future, if the assessing officer were to pass an order relating to the earlier period, he will pass an order, but he will raise the demand of nil amount if supposedly no further amount is due from.
I think that assessment is almost stillborn.
Yes.
The only question will be that, can the incoming successful resolution applicant pursue the assessment in order that it may result in a loss which he can claim set off in the future? I think those are open questions.
So I think basically the new officer who passes the order, he would pass an order. This may be relevant for determining for example, my losses. He may reduce the losses, there may not be a demand. But if in case he were to make an addition and create a demand relating to an earlier period, probably the demand notice will have to say nil, because as per the resolution plan, no amount is payable to him.
I think another related question, again, we'll leave it for the future, but I'm just raising it for the sake of, bringing it to the notice of the House, is what if there are penalties in the past and, the previous management or the previous ownership is responsible. Let us say there are penalties for misappropriation or for falsifying books. Now, obviously, that can't be recovered from the resolution applicant. But the question will be, can they hold the earlier erstwhile management or the erstwhile owners, guilty of this process? Because they may be guarantors, they can be proceeded against. I read that the Supreme Court has obliquely left this open, that whether the authorities can move against the erstwhile promoters or the erstwhile owners. So this remains to be seen how this will, pan out in the future.
I think a very interesting question someone has put: what happens to my earlier refunds? Whether those refunds I will still be entitled to receive, or they will also get adjusted against my old outstanding demand.
So I remember reading a case. I am not fully recalling that. There was a refund that came in, and the incoming resolution applicant said, this is an asset of the company that I should inherit, that I will acquire. So this should be part of the balance sheet of the debtor, corporate debtor.
So basically, from department perspective, you see, they will have to issue you the refund, but they cannot collect the amount because you don't have the money. So these are all interesting questions. I think,
absolutely.
These will arise as we go along. But this, I think, is a very, very important and a welcome amendment, because in the absence of any provision in the law itself, the assessing officer was not able to give effect to the IBC, the NCLT order, and the demand used to be there in the demand dossier, and they used to recover it. One was forced to, file a writ petition or maybe go to the courts and then get, or before the NCLT, in order to get a direction to get it reduced.
Right.
So this is an important and a very interesting amendment. I think let's move on. There are a few other important aspects also. Section 79, I think is a very well, I'll quickly wrap up this because we are running against time. Section 79 is basically only to facilitate, the PSU disinvestment. And Section 79 says that if there is a change in shareholding of more than 51%, then in that situation, the losses are not available to this. Losses are not available in the succeeding year when the change in shareholding takes place. Now, in order to facilitate the takeover of the PSUs, maybe in the light of, the Tata taking over the Tata's taking over Indian, Air India, etc., or maybe any other PSU which is a company to which Section 79 applies. In that situation, the law is proposed to be amended to provide that even in a case of change in the shareholding, if it happens, then Section 79 would not apply, provided the new promoter continue to hold the shareholding for some period of time as prescribed in the law. So this again is an important and a welcome amendment, particularly in the context of PSU disinvestment. Now moving on, I think the slum sale, this is only a clerical issue which has been rectified. The word sale was mentioned instead of the word transfer, I think, which has been proposed to be clarified. So I'll move on to the next amendment, which is the next is basically with regard to the dividend stripping. Again, this is also to an extent a clarification because Section 94 presently does not apply to investment in infrastructure investment trust and real estate investment trust. Now the dividend stripping and bonus stripping provisions are proposed to be made applicable even in those cases. So to that extent, this amendment has been made in Section 94. Now
So
the
I
next
think, Rohit, this bonus stripping now covers shares also.
Yes.
Earlier it was only with reference to units. So
Correct.
it now covers shares also. That's an important one.
Correct. Now moving on, this IFC is this gift city. Now, in fact, our office is also working extensively on this IFC provisions, and maybe we'll come out with some document on this also in shortly. The government has been incentivizing the setting up of units in IIFC, which is basically a Gujarat gift city, etc. So there are basically the 3 or 4 new provisions which have been brought, new incentive provisions which have been brought in order to incentivize the setting up of the units in the IFC. One is basically income of a non-resident on transfer of offshore derivative instruments entered into with the offshore banking unit. So basically, if a banking unit is in an IFC zone and there is a non-resident who enter into the offshore derivative instruments transaction with this offshore banking units, that income will be exempt from tax. The second amendment is the non-resident getting an income by way of royalty or interest on lease of a ship paid by a unit of IFC. So basically it is to presently the aircraft industry is being promoted. More and more lessors are promoted to, set up their units in IFC who leases the aircrafts. Now it is being sought to be extended to shipping industry also. So more and more persons who are the owners of the ships who enter in, who does business of leasing of ships, any income received by them in the form of royalty or interest from leasing of ships will also be exempt from tax. The third incentive basically is non-resident income from portfolio of securities and of financial products, which again is entered into with an offshore banking unit set up in IFC. Again, to incentivize the setting up of the offshore banking units in the IFC. And the last is if there is a ship, if a shipping company, if a company which owns a ship is a unit in IFC, so its income is exempt from tax. That is one amendment which has been made. Secondly, any income which arises to it from transfer of that ship is also proposed to be, granted as a deduction in terms of a new amendment in Section 80LA. So these are few important amendments in the context of IFC. The next issue is 115 BAB. As you all know, this provision was brought in October 2019, in sometime in 2019, in order to incentivize setting up of the new company engaged in the business of manufacturing. Now the sunset period for setting up of that new, for starting of the manufacturing is, in the existing provision, is 31st March 2023. Because of the COVID, last 2 years, there have been various companies which have been set up. But because of the COVID issues, or they may be from other issues, because of other issues also, many companies were not able to commence the manufacturing operations by 31st March 2023. And it was in fact an industry demand to extend that period. So there, the Finance Bill proposes to extend the period by 1 year to 31st March 2024. And similarly, the next amendment in the context of startups, basically for extending a period of 1 year till 1st April 2023 in terms of Section 80 IC amendment. Section moves to the next slide. 80 IC amendments to extend it for 1 year. I'm rushing through these provisions because these are more of a very procedural provisions. The only point which I would want to emphasize is probably the industry demand was to increase it by 2 years or 3 years. But as of now, the legislature or the government has thought it fit to extend it by 1 year. Maybe in case there are because of pandemic or any other issue, they may extend it further in the subsequent period. Now moving on, I think next is a very important amendment. This is a very interesting amendment in which I would ultimately, in fact, invite intention or comment from Mr. Vora and Neeraj also, if he may chip in. Now this is an issue of filing of updated returns. This is a very novel and a new concept which has been brought which is proposed by this finance bill. To put it shortly, the concept says, under the present scheme of act, I can file either the original return, which is the times provided under 139(1). I can file a belated return under 139(4). I can file a revised return under 139(5). Or I can cure the defective return. Now all there are time-bound manners. I can only do this action. Now in order to incentivize or facilitate, compliance on the part of the taxpayer, the finance bill proposes to give a window of 2 years to file an updated return. So 2 years from the end of the relevant assessment year, the taxpayer will be able to file an updated return. They are calling it as an updated return. If they want to offer some new additional income in the updated return, there are few exceptions to it. I'll come to that also. Now the only requirement is twofold. One, the updated return must require payment of course, basic tax has in any case to be paid. The updated return should require payment of additional tax. So 2 assessment years you can file it. If the updated return is filed within 1 year from the end of the relevant assessment year, 25% of the additional tax has to be paid. If the updated return is to be filed, within from 12 months to 24 months. So for example, after 1 year, then 50% of the additional tax has to be paid. The mandatory condition is when you file this updated return, all the taxes have to be paid in advance. And the challan for payment of taxes has to be filed along with the return of income. Of course, you get credit of all prepaid taxes, all the credits, 115J, 115JB, etc. After all that adjustment, whatever is tax payable by you, that tax has to be paid along with additional tax. Now they have categorized it in 2 categories. One is a category of non-filers who have not filed their return of income earlier. And the second category is where the return has already been filed either the original return or a revised return or a belated return. So these are 2 categories. In case of the persons who have already filed their return of income, obviously they will be filing the return of income with additional tax. In case of the non-filers, they are required to pay the tax which they may not have paid on the basic amount on which the return was not filed, plus the additional tax has to be paid by them along with the return of income. Now there are certain exclusion categories. In case of a loss return, you are not allowed to file a updated return. Any return which results in reduction of your liability is also not allowed to be filed. Or any updated return cannot result in a refund or cannot increase the refund which you may have already claimed. So this is a category which is prohibited. The second category which is prohibited is search, seizure and requisition. So in a case where search, seizure and requisition has already been happened, in that situation you cannot file an updated return. The third category which is prohibited is a case where assessment is already pending, a reassessment proceedings is already pending. Some of the category of cases like black money, prohibition of benami transactions, etc. Or in a case where prosecution has already been launched. So this is in sum and substance the scheme of filing of the updated returns. I think there are few issues which are arising in the context of the filing of the updated return. And in fact, this is more of a conceptual issue if I raise. So for example, in a case of a loss category, that has been excluded from the category of filing an updated return. Personally speaking, my view was when they are permitting the filing of an updated return, they should have permitted the filing of a loss return with the caveat that on the notional difference between the loss which I may have claimed in the original return and the loss which I am now showing in my updated return, I have to pay additional tax. So some amount they may categorize maybe 10%, 20%. This is primarily for the reason, in case of a loss to loss also, there is a penalty provision. So in order to ensure a voluntary compliance, so for example, someone may have inadvertently claimed 100 crores of loss in its original return of income. He may subsequently realize that my loss should be 80 crores only rather than 800 crores which I have claimed in the original return. Presently, that is treated as a prohibited category for the purpose of filing an updated return. So my suggestion probably would be the finance bill should permit filing of revised return, even updated return, even in this kind of a situation. The law may provide that on this difference of 20 rupees by which I will reduce the loss, I should be directed to pay some additional tax for revising or for updating my return of income. So that's, I think, is a suggestion on that they should allow. Secondly, I think there are debate which is going on as to why an assessment, a person in whose case assessment is ongoing, why that should be treated as a prohibited category. Because when the assessment notice is received, probably because in a case where the assessment notice is received, I am totally barred from filing an updated return. The law could have provided that in a case where the assessment proceedings are on, probably you file an updated return again with an additional tax. So that is like paying an additional tax, which in a way takes care of, there being no protected litigation thereafter, and you are being, subjected to some kind of penal consequences in the form of payment of additional tax. I think these are two conceptual issues which I wanted to raise. An important issue which I wanted to raise is there is no specific provision which has been no specific amendment made in the context of penalty clause provisions. So a larger issue which basically arises, what is the nature of this updated return? Whether this is like a revised return which substitutes my original return and therefore my penalty has to be determined or computed with reference to my updated return, or it is a return which is different from a revised return, does not step into the shoes of my original return, and therefore probably I am subjected to penalty. I think I will invite comments from Mr. Ora and maybe Neeraj sir on this issue. These are two broader issues which I think wanted to raise.
Rohit, your first point that that 100 crore loss you are reducing to 80 crores, I don't find a bar. The updated return, they say the updated return is a return of loss. So you have already originally surrendered the loss of 100 crore. Now you are reducing it to 80. So you can check that out. That's one.
Right, sir.
The second is, like you said, if the assessment is pending, now the larger question is, when can the assessment be said to be pending? Now you file a return, suppose your year closes on 31st March and you are a corporate assessee, your return is due by 30th November, I think, right? Or fall in 30th. If you are a corporate assessee, your return is due by 30th November.
Depending upon whether I am a TP case or a non-TP.
Okay, chalo, let us assume you are a TP case, so 30th November following. Now, your notice under 143(2) has to be issued within 6 months from the end of the relevant assessment year. Is that correct? Your notice under 143(2) will
has to come within 6 months
from the end of the relevant assessment year. So this 2 years period that you have, it will be very difficult to say that your assessment is not pending, and merely because you've received a notice. Now, can on that basis one possibly say that the assessment is pending if it's just a routine notice? And the 2 years that you have, normally an assessment would get completed before 2 years from the end of the relevant assessment year, na? Is that correct?
153 now, yes, time limits are there, right?
So this will really serve no purpose if you are going to say that your assessment is pending or your assessment is completed.
Right.
I think this 2 years is not realistic in that sense. And if you are going to treat this as not a revised return, at least for computation of penalty, then people will not want to voluntarily come forward and surrender income, because that will amount to an admission. And in that,
sir, any reason why they have not amended section 270A? Or
no, I think it has missed. I raised it yesterday, and Mr. Kamlesh Vashne took note. He said, yes, this could be something that we need to consider. And
no, but in case it is to be treated as a return in substitution of original return, probably we don't require a 270A amendment.
Yes.
Because in that situation, there cannot be a penalty on my...
No, but I think people will want clarity. You need to have clarity before people can, opt for this. And this timelines that also need to be brought to them, that, the time for filing return, time for issue of notice under 143(2), time for completion of assessment. So if then again this provision will not be used frequently by people if the timelines get over by that situation. And the authority for advance ruling, you have a similar provision which says that if an issue is pending consideration before the assessing authority, then in that situation you cannot file for advance ruling. Now there they said merely because a notice under 143(2) has been issued or a questionnaire has been issued, that cannot be the basis to say the issue is pending in assessment. So this is also something that they will need to clarify. Otherwise, the use of this provision will be few and far between. So it will almost be like a dead letter. I think that they need to...
In fact, as you rightly said, in fact, most of the corporate assessees are subjected to scrutiny assessment.
Right.
And by, providing for a provision which says that in all cases where this assessment is pending, you are barred from filing an updated return. You are effectively, taking out most of the corporate assessing from the ambit of filing the updated return.
Right.
Whereas
even wherever there is a scrutiny assessment, they will not be eligible.
Yes.
Because the notice would have been received by then.
Correct. So to that extent, rather than, they should have permitted it to file the updated return even in a scrutiny cases. Maybe with a small additional tax of 5%, 10%, depending upon the time within which that updated return is filed.
Yeah. You are already levying an amount. You are claiming the 25%, 50% additional tax as a precondition.
Also.
As a precondition to filing the updated return.
Correct.
So that's almost like an entry cost for filing the updated return.
Correct. So just to answer your point, sir, this says provided that the provisions of this section shall not apply if the updated return is a loss return, is a return of loss.
No, I am only on the point that if the original return is a loss return, and then you file the updated return, original return is in time in terms of section 80.
Right.
Then you are only lowering the loss quantum.
Correct.
So that's probably an issue that will need to be considered.
Correct. Neeraj, you want to chip in or should I move to the next one?
What I'm saying is, while you are right that there is no corresponding amendment under section 270A, but considering the provision as it stands, this updated return would also be considered as a return filed. So the provision would have to be construed in that manner, section 270.
Right. So let's move on to the next issue of, the faceless assessment. Now, this is again a faceless assessment. There are few amendments which are made, and these are some of the amendments are the important amendment which have been made. In fact, this is faceless assessment. resulted in a spate of litigation, at least in Delhi, wherein lot of orders which were passed by the NFSC were subjected to writ petitions, being violative of the principles of natural justice as contained in section 144B. Before coming to that, if I just point out the slide which is there on the screen, basically there are almost all the the assessment process is presently being moved over a period of time to the faceless regime. Now, faceless determination of arm's length price was, again, there was limitations to draft and move to the faceless regime. So 2022, 2023, etc. for tribunal. Now, that is the first amendment which is proposed is with regard to this, and they are proposing to extend the period for moving to the faceless assessment procedure by 31st of March 2024. So this is one amendment which is proposed. The other important amendment which is proposed is under the faceless assessment scheme itself. Now, if you see the present scheme of section 144 capital B, the litigation basically arose because of the non-compliance of the procedure which was contained in section 144B. There was no error as such in the procedure which was there in 144B, but probably the department thought it fit, or the finance ministry thought it fit to amend the provisions and dilute some of the provisions and maybe realign some of the provisions. And so what we have done in this first slide is we have tabulated what was the existing provision and what is the proposed amendment which is made. I will very quickly explain how the faceless assessment scheme will now flow, rather than taking everyone through these slides. These slides we will in any case circulate to everyone and one can go through in detail. The new process basically under section 144B would be my return once it is taken up for scrutiny. I will be given a questionnaire. After giving all those questionnaire, the assessing officer, the assessing officer is basically the assessment unit within NFSC. If the assessment unit is agreeable with the return of income which has been filed by me, and the assessment unit does not propose a variation to the return of income, then a new thing which is called as income loss determination proposal will be prepared by the assessment unit. And that income loss determination proposal will be forwarded to the NFSC. That is one leg. The second leg is where there is a variation which is proposed. In that case, the NFSC will issue a show cause notice to us, and that variation will be confronted to the taxpayer. And I will be required to file a reply to the show cause notice. Thereafter, again, the NFSC will, or the assessment unit of the NFSC will prepare a income ILDP, which is called income loss determination proposal. Thereafter, it again goes back to the NFSC. NFSC may accept the ILDAP or it may send it to the review unit. If the ILDP, which is the income loss determination proposal, is sent to the review unit, the review unit will give its comments on the ILDP based on their own mechanism. It will come back again to the assessment unit. Assessment unit, after considering the review unit's proposals, will decide whether or not any variations are required in the assessment order, and on that basis an final assessment order will be prepared. How the new regime is different from the old regime or 144B as it exists today is, in the existing regime there are 2-3 very important salient features which have now been done away with. One important salient feature in the existing faceless assessment scheme is that for every variation which is proposed by the assessment unit and ultimately goes to the NFSC, the NFSC is mandated to confront the taxpayer with the draft assessment order. So draft assessment order is like a show cause notice to the assessee in order, and the assessee is given an opportunity to respond to that draft assessment order and offer its comments. Now, after that draft assessment order, after the comments are, after the objections are filed, the NFSC again goes through those objections, and in case there are further variations which are proposed different from the variations which are proposed in the original draft assessment order, they are again supposed to confront us with the draft assessment order. So there were principles of natural justice, the principles of natural justice which were ingrained into the scheme itself. Now the major difference in the new scheme is I am only given a show cause notice now. I am not given a draft assessment order. So the new scheme does not dispense with the requirement of issuing a draft assessment order to the taxpayer. He is only given a show cause notice. And once a show cause notice is given, I am entitled to file my objections. I am entitled to a hearing. And thereafter, after considering my objection, the assessment unit will prepare, after considering the review unit's proposal, will prepare the final draft assessment order. One more important change which has happened is, in the existing regime, in case of a TP assessments which were used to happen, where TP variations were made, there were two draft orders which were there. One draft assessment order was given to us in the first instance, and then after the considering my objections, another draft order is prepared which goes to the DRP route, if so, opted by the taxpayer. So these are the various stages which were there in it. So the material change which has happened is no draft order being given to the assessee anyhow. Now the assessee will only be issued as show cause notice. Assessee will, of course, will have a right to respond to the show cause notice, and after considering the objections to the show cause notice, the assessment unit will prepare the assessment order based on after considering the entire material. Another important amendment which has been made in the new scheme is that it goes back to the same assessment unit. So earlier, the existing scheme provided for the going through various assessment units, not necessarily to the original assessment unit. Now, whenever the draft or the orders are passed, they are goes back to the original the assessment unit itself. So these are broadly the changes which have happened. One very important change to another important changes which have been made is one a positive amendment and another is a negative amendment, I would say. The positive amendment is in the context of the existing law. The law said that it is not mandatory for the NFSC to give an opportunity of hearing to the taxpayer. And lot of litigation arose in that context because people used to challenge non-grant of personal hearing by the NFSC before passing of the final assessment order. Because as per the department, it was optional, it was not mandatory for the assessee being given an opportunity of hearing. In the new scheme, new faceless scheme, it is now mandatory to give a personal hearing. So the taxpayer will have a right to a personal hearing if so opted by him. That is one very positive amendment which has happened. This second amendment, which according to me is probably not a very amendment which will be welcome, is the retrospective deletion of subsection 9 of section 144 capital B. Existing provisions of subsection 9 says that if there is any violation of provisions of section 144B, which basically contains all the principles of natural justice, giving an opportunity, etc., then any order passed in violation of the procedures which is given in 144B will be regarded as non-est. In that context, there is a lot of litigation which is pending in various courts as to what is the effect of that subsection 9 of section 144B. Now that section itself has been deleted with retrospective effect, meaning thereby the department is going to contend that just because there is any violation in terms of the procedure which is given in section 144 capital V, that will not result in the assessment order being treated as non-est as mandated by subsection 9 of section 144 capital V. So this is in substance all the amendment which have happened in the context of faceless assessment scheme. I think a very important question which arises is with regard to this deletion of subsection 9 of section 144 capital V. I would request Mr. Vora's comment on this, sir, as to how you look at this, deletion of subsection 9, that too with retrospective effect from 1st April 2021, and what will happen to the pending litigation on this particular issue which is pending in various courts.
So Rohit, basically, I think this was one provision in the statute which, provided for itself that if the tax department faltered in making an assessment, in not following or missing one of the steps in the entire procedure for faceless assessment, the assessment would be treated as non-est. Now that would have meant that the order was null and void, and there would have been no opportunity for the tax authority to frame a fresh assessment unless there was limitation to pass a fresh order. Now this 144B9 was not really used by the courts when they set aside the assessment, especially in regard to non-affording opportunity of being heard on violation of principles of natural justice. But we were pushing in some cases that the court should strike down the order as non-est in view of this specific provision in the statute itself. So with this retrospective amendment, and I thought that basically this is a provision where the department is made accountable for its lapses by seeking to hold the assessment as non-est. Now the government has taken away this provision by this proposed amendment in the finance bill of 2022 from the date of inception of the faceless procedure. So invariably now the court will only have to fall in line and will have to interpret the section as it stands from that particular day. So this amendment will have to be read in as in the statute on 1/4/21. And the court will now only set aside the assessment, giving the department an opportunity to make a fresh assessment, to make good the loss or to make good the deficiency in the earlier assessment. So I don't think there will be much success in seeking to challenge this retrospective deletion of section 144B9.
And second, sir, issue which I would raise for you is, as I said, in the context of the existing provision, at every stage where there is a variation which is proposed, which is not confronted to the assessee, there was a requirement to pass a draft assessment order.
Correct.
And that draft assessment order being confronted to the assessee.
Right.
Now the new scheme says that they will confront us, of course, they will give us a show cause notice. But the law does not specifically provide that in case the final assessment order were to contain any variation, which was not confronted to us in the first show cause notice, whether they are supposed to issue me another show cause notice. So how do you look at this? Is it still mandatory for them to issue a show cause notice?
No, if they make an adjustment which was not there in the initial show cause notice which was put to the assessee, clearly that will be violative of principles of natural justice. Again, you are not put to notice of what they are intending to do. So I would think that even if the law does not mandatorily provide, as part of good practice, good governance, they should confront the assessee with the proposed adjustment that they are seeking to do. Otherwise, again, the assessment will be set aside on grounds of violation of principles of natural justice.
So basically, this is something implied.
Yes,
They cannot do away with.
It is inherent, yes.
Correct. So I also thought that despite the fact that it doesn't specifically provide for it, but as part of principles of natural justice, it is mandatory for them to give me another show cause notice.
Absolutely.
So they cannot say that we have technically complied with the provision by issuing you one show cause notice.
No.
Correct.
I think this is only on first principles.
Correct.
Yeah. We don't need a provision in the Act for this purpose.
Right, sir. So I think I should move on because we are running against time. We have GST, the indirect tax also. So moving on to the next provision, rationalization of provisions relating to assessment and reassessment. Now, before I start with it, I think there was a lot of anxiety among people as to what are the amendments which are made in the context of reassessment provisions, and particularly whether any of the amendments has the effect of diluting the principle of Delhi High Court in the case of Manmohan Kohli. So to begin with, I must clarify that there is no amendment which dilutes the principle of Manmohan Kohli. So people can rest assured, as of now, the principle which has been laid by Manmohan Kohli stands. What will ultimately happen to just the principle of Manmohan Kohli, we don't know, because what we understand is the Allahabad High Court, which was the first judgment on the issue of non-violation of the new procedure of reassessment, the department has already filed an SLP before the Supreme Court, and they are likely to similarly contest the decision of the Delhi High Court in the case of Manmohan Kohli also before the Supreme Court. So to that extent, I think I will clarify that there is no amendment. So I don't do so because there were a lot of anxiety, people were probably expecting that there may be some change, in order to dilute the principle of monopoly. That is one thing I wanted to start with. There are few amendments which are more of a clarificatory or to fill up the gaps in the existing provision. And there are few amendments which are substantive in nature. I will more concentrate on the substantive provisions. Rest of the provision we have actually given in the slides. The two items which I wanted to highlight, of course, we have given a tabulation. Saksam, if you move to the next slide, what we have tabulated is the existing provisions of 148 and the new amendment which have been made. The issues which I wanted to highlight is few. One is, as per the existing provisions of the existing new procedure which has been enacted by Finance Act 2021, the reassessment is information based within 3 years. At least for first 3 years, the reopening of assessment is information based. And a definition of information is also given in explanation to section 148. Now the definition of information is sought to be expanded. The information is now sought to be expanded to provide that it will also include any audit objection, information received under DTAA or section 135A returns, or information will also include any order of tribunal or a court requiring an action. So the information has, the scope of information has been widened to include this also. So within first 3 years, when the assessing officer can reopen my assessment only on the basis of specific information, the scope of information has been expanded to include few more items. The second important amendment which has happened is in the context of the reopening which happens after 3 years, but up to 10 years. As we all know, under the law as enacted by the Finance Act 2021, after 3 years, it was permissible for the department to reopen my assessment if the escapement was of rupees 50 lakhs or more and it was only represented by an asset. Now that is being expanded to include the 3 items. One, asset is already there. Second is expenditure in respect of a transaction on in relation to an event or an occasion. And the third is a very, I would say, a very generally worded expression, entry or entries in the books of accounts. Now, what really bothers me is this third item, which is an entry or entries in the books of accounts. This will probably and possibly cover each and everything. What basically it does is any entry in the books of accounts which results in an escapement of income probably may result in a reopening of assessment after 3 years. When the new scheme was enacted in 2021, I think that was not probably the intent. The intent was that after 3 years, the reopening can be done only to tax undisclosed assets. Because if the definition of assets is seen, it is basically for any cash deposits in banks, assets which are not disclosed, entries within the nature of section 69, 69A, etc., etc. But now that has been extended to include expenditure in respect of transaction in relation to an event, or C is an entry or an entry is in the books of accounts. Second item I would assume would only cover a situation when an expenditure is not recorded in the books of accounts. But then again, this is an open issue because what may happen is I have incurred an expenditure, I have recorded in my books of accounts. The department might say that expenditure in respect of a transaction which you have recorded in the books of accounts is not allowable to you, and therefore I reopen your assessment after 3 years. This will again be an open issue. How the courts are going to interpret, we don't know, but this is issue. The third entry is entry or entries in the books of accounts. This is a very, very ambiguous kind of an expression which says that this can result in a reopening of assessment. I think this is the major issue which I would request, maybe Mr. Vora, would you want to highlight or comment on this expression, entry or entries in the books of account? What could be the logic of, including this expression for reopening after 3 years?
Rohit, basically, I think I would like to preface my comments by stating that this extension of time limit from 3 to 10 years is in a situation where the assessing officer has in his possession books of accounts or other document evidence which revealed that income chargeable to tax represented in the form of so and so has escaped assessment. Now, this is clearly not referring to your regular books of accounts. It is not referring to your regular return of income. He must have some information, some document, which are or books of accounts or duplicate books of account, which has come to his possession, which reveal these entries. So therefore, this extended time limit will apply only in that situation, not with reference to your expense debited in regular books of accounts or the entry in your regular books of accounts with which he does not agree.
So you are putting it in the context of the main expression, which says that there has to be an evidence of a possession of books of accounts.
Yes.
So this does not cover my regular books of account.
Books of account, yes.
But would cover a situation like a search case where my, say for example, my books of account which are not disclosed to the income tax authorities are found during the course of search. And
or he gets a document from another assessing officer. Now with that search provision being moved away, so another from the assessing officer of a search person, he receives a document which says that there is some entry relating to your assessing. So
I would say that this will be very heartening to note by all the the participants over here. If this is the interpretation.
No, this is the interpretation. This is not meant to be sitting back in judgment of what you allowed or disallowed in your regular assessment. Otherwise, the time limit is 3 years. I think that is sacrosanct and binding.
So basically, what happens is all my legal issues, legal claims, which are already recorded in my books of accounts, they get finally settled within 3 years. The reopening can only be done up to 3 years.
Yes.
After 3 years, these items will kick in only in a situation where he has evidence, which effectively means anything which is not recorded in my regular books of accounts.
Books of accounts, correct. And for which he has evidence or documents.
No, I think this is a good interpretation which you have given. I think this will be an important thing. Another important amendment which I just wanted to highlight is the amendment which permits the department to reopen multiple years. So, for example, the present section says that the escapement has to be 50 lakhs or more in order to reopen the assessments. Therefore, for every year, the 50 lakhs threshold has to be crossed. Now, the amendment which is proposed is, say, for example, a marriage happens or an investment in a property happens, and that is the investment is spread over a period of 3 years or 2 years.
Correct.
So, for example, 70 lakh of investment is done. In that situation, the threshold of 50 lakhs will be treated as crossed, and it will be open to the department to reopen your 2 years in order to tax that 70 lakhs of rupees.
Right.
So I think this is another important amendment.
Right.
One question which has been raised in the Q&A is, so what would be the meaning of this expression when they are saying information would also include any information requiring action or on the basis of the order of the tribunal or a court? Of course, this is within 3 years. Because information is required only for the first 3 years. So information, for example, there may be so many tribunal judgments across the country. So can the department, rely upon one singular tribunal judgment and say that, look, on the basis of this, I have the information of escapement and therefore I am reopening your proceedings. This, of course, will be subject to crossing the threshold of income escaping assessment. So income escaping assessment on the basis of the order of the tribunal. So I would tend to think that of course, that can be a basis of an information. The tribunal order can be a basis of the information. But the assessing officer is still to cross the threshold of income escaping assessment.
No, but here 150 stands as it stands. 150 talks of action to be taken in pursuance of an order of the court or in any other proceeding.
That is basically to lift the limitation.
So here this information which requires action in consequence of the order of a tribunal. Now you may have a judgment of the tribunal which favors the revenue. You may have equally number of cases which support the assessee's case.
Correct.
Now, whether on that basis, when you say any information which requires action in consequence of the order of a tribunal, I think that is not mandated by the tribunal. I think that action must follow a diktat or a direction from the tribunal or the court.
Actually, It does not use, has the word direction of the tribunal. It says a consequence of the order of a tribunal.
Many which requires action in consequence of the order of a tribunal. Otherwise, it would have said any information would mean information resulting from a favorable order of the tribunal, favorable to the revenue.
So it should directly flow from the order of the tribunal in order to constitute an information.
So 150 mein this provision is there, na? If you have to reopen a case.
But that uses the expression direction. That uses the expression finding or a direction. Those two words are actually missing.
150 is still retained, no? 150 is still retained.
Yes. So that I think is again an open issue. I'll just move on because of paucity of time, we will come deal with this in a little while. Neeraj, the next issue is section 263 amendment in the context of TP. You would want to highlight this amendment quickly?
Yeah, of course. Actually, as you are aware, section 263 grants power of revision to the commissioner and the chief commissioner and the commissioner. Revision of the order which is found to be erroneous and prejudicial to the interests of the revenue, order passed by the assessment. Now, there was no specific amendment provision providing for revision of the order of the transfer pricing officer. Order passed under section 92 CA by the transfer pricing officer. Now, this amendment is being proposed for revision of the order passed by the transfer pricing officer. Now there is a time limit which is provided for the action or revision under section 263 is 2 years from the year in which the transfer pricing officer has passed his order. If you see the assessment process after passing of the order by the transfer pricing officer, the regular assessment process. So the draft order is passed within 60 days. Thereafter, the matter goes to the DRP. DRP gets 9 months, and thereafter, after DRP's direction, within 1 month, the final order is passed. So it is 1 year from. It takes 1 year from the passing of the transfer pricing officer's order to normally get the final order. Now, assessing of the commissioner or the chief commissioner now thereafter would get 2 years to revise the transfer pricing officer's order. So in effect, the revision under section 263 would be happening in respect of the final order which has been passed. So the final order passed by the assessing officer may get revised to the extent of the revision which takes place in respect of the transfer pricing officer's order. So in other words, by virtue of this amendment or this provision, what is sought to be revised is an order passed by a final order, assessment order passed by the assessing officer. Even after the order has been passed pursuant to the directions or the draft order has been seen by the DRP and directions have been issued by the DRP or considered by. So secondly, what is happening is that when a transfer pricing assessment happens, the transfer pricing the taxpayer has already filed a detailed transfer pricing study in respect of each of its international transactions. There is a certificate from a chartered accountant and a threadbare TP assessment that takes place, wherein so in other words, the entire material related to the international transaction is before the transfer pricing officer, and it is actually already considered by the transfer pricing officer in the transfer pricing officer's order. So in that event, when the commissioner seeks to invoke rigors of Section 263 and to revise the transfer pricing officer's order, so long as it is in relation to those international transactions which, in respect of which the transfer pricing study has been filed, or they have been reported in the transfer pricing study, and they have been considered by the transfer pricing officer. I have my doubts whether that order could be called an erroneous order so as to invoke provisions of section rigors of Section 263. What I'm feeling or considering is that the provisions of Section 263 is sought to be brought in, or maybe to take care of other information, etc., which have come in after passing of the order by the transfer pricing officer, or which has not been noticed by the transfer pricing officer, maybe by way of CBCR or exchange of information. Many information may come in from overseas, which may not have been taken into account in during the course of the transfer pricing assessment. So that is one comment or observation that I have. Secondly, you see, in a judicial or administrative process, it cannot be Caesar to Caesar. There is a settled judicial principle that a person or an authority at a particular level cannot be reviewing actions of taken by another authority or at the same stage or same level. So if these revision orders are if they were to be passed by a CIT or the commissioner, in that event, they would, in other words, they would be reviewing the order passed by the DRP. So to that extent, I think it can be possible to challenge such an action or such an effort. Of course, if the revision order were to be passed by a chief commissioner instead of a commissioner, then the situation would be different.
So I think, sir, we are running against time. I'll just quickly wrap up the two important issues, and then we'll hand it over to our indirect tax team. One is litigation management. I think we discussed it. So the only issue which I wanted to raise over here is, now this of course is a very welcome amendment which has been made, which permits the department not to file an appeal before the tribunal and the High Court. I actually fail to understand why Supreme Court has been left out. Probably I am missing out something. That is one. Second important thing which I wanted to understand, because this is subject to the consent of the assessee. Now, the new section actually includes a case where the question of law is pending in any other case. Now, if it is pending in any other case, if I were to give a consent to of not filing an appeal, I will not be able to represent it before the High Court or the tribunal in that matter. So why would an assessee, where a question of law is pending in someone else's case, will give a consent? That I think are the two larger issues. If you want to give your comments, and then we will move on to the next one, sir.
So I think basically then it's the option of the assessee. Like for instance, if you permit them to file an appeal to the tribunal, you have to go through the rigmarole of the appeal being filed, cost being incurred. So every assessee will take his own call whether or not he would want the department to pursue the matter, or he would want the department to wait until the matter is decided in any other forum. Or if the assessee has similar matters pending in the court for earlier years, he may then opt that for the subsequent years they need not file an appeal. So the contours will still have to be worked out, but clearly as a provision, as an enabling provision, it is very welcome.
Of course. So I think moving on, there are two things only. I'll just wrap up in 5 minutes. One important amendment is in the context of TDS on immovable property. Saksham, just move on the slides very quickly. Come to TDS on immovable property. The existing provision says that the TDS has to be deducted when we purchase the property at the sale consideration. The amendment which is proposed is that if the TDS has to be deducted on the stamp duty value or the actual consideration, whichever is higher. Actually, this, according to me, I am not able to understand the reason of this amendment, because initially when this provision was inserted, the reason which was given was that they wanted to identify the sellers of the property, so that then tomorrow if the seller of the property were not to offer the capital gains for tax, they can at least recover the taxes from those persons. So it was more of a deterrent and more of a identification process which was done. Now when they are amending when the finance bill proposes to amend it to say that stamp duty value or the actual consideration, whichever is higher, what actually happens is, in, say for example in Noida, etc., in that various places, the stamp duty value is actually much higher than the actual fair market value of the property. So it will result in a compliance burden on a buyer, who will first have to get a determination as to what exactly is the stamp duty value on that particular date. Then thereafter deduct TDS on the stamp duty value. And it will be more complicated in case of person buying it from for example a builder, where installment plans are there and the payment is made in various installments. So every installment which is to be paid to the builder has to be topped up with the stamp duty value, and the TDS has to be deducted proportionately on that higher amount. So I think this will become more of a compliance burden rather than resulting in any specific advantage to the income tax department. So, sir, you are on mute. Sir, you are on mute.
And as you said that, once you've identified the buyer and the seller, both in their respective returns, one has to report capital gains basis the stamp duty value. The other has to, in terms of 56(2)(10), deal with this question of the stamp duty value. So
Correct.
This identification is already there. Consequential action needs to be taken by the department. This is causing an unnecessary compliance burden on the buyer of the property.
Next important issue is in the context of 28(4) and 194(r). Actually, this is a very interesting amendment which says that on any benefit, any perquisite any benefit under section 28(4), the person who is giving the benefit is actually will have to deduct TDS at the rate of 10%. In fact, this is a very industry issue which is coming. In fact, there are some Q&A also on this as to how this will be operationalized. So, for example, there are various MNCs who take their employees for example, for vacations outside India. So that is, they may take their, the various distributors are given depending upon their achievement of the targets. They are taken out of India or they are given various incentives. These are basically business promotion expenses which are undertaken, which may indirectly result in some benefit or a perquisite in the hands of the recipient of the service. So, for example, a distributor, a big distributor, achieving a target, he is given a free tour for, say, for example, to Switzerland. Now, what it will happen is, in terms of section 194(r), the company which is giving that benefit to that, the distributor will have to also deduct TDS on this amount. And the recipient of the benefit will also be subjected to tax as business income. So I think this will result in lot of issues. At least is an industry-wide issue. Another important thing which will get affected is the existing controversy on section 28(4), whether or not it applies to haircuts which happen in terms of IBC, which happens in terms of OTS with the banks, etc. So whether that will also be regarded as a benefit or a perquisite, and then the TDS will have to be deducted. And if TDS has to be deducted, who will deduct the TDS? Whether the banks will deduct TDS on the amounts of the haircuts, which they are actually not getting the money.
Right.
So they are not even able to realize, first of all, whether 28(4) itself is applicable. If at all applicable, who is to deduct TDS? So I think there are a lot of issues. The amendment has been brought in, but practically it is very, very difficult to implement in every situation.
Right.
So many law firms actually take their people to, for on a tour, which is both a recreational tour as well as a study tour. So how do you bifurcate the amount which is relatable to personal benefit and amount which is relatable to, the study tool. So there are, I think, lot of industry issue on this. Probably department will have to come out with lot of clarification. In fact, also an issue of discounts. The discounts being given, the turnover discounts being given on the sales, etc. Whether 28(4) will also apply to that. According to me, it should not. But then all these are practical issues. They have brought out with a provision, but without realizing the impact of this amendment and the compliance burden which it will result. They will have to come out with lot of clarification, I think, on this issue.
Right.
Then the last
there
is
many interpretative issues on what constitutes a benefit or perquisite.
correct.
And when it says, like the Mahindra judgment of the Supreme Court has said, if it is in cash, it is not under 28(4).
Correct.
All those issues will arise, yes.
And the last is only perquisite. Last is only trust. I just point out the trust is more of a realignment. The existing provisions of section 1023C are realigned with the existing provisions of section 11 and 12. So the amendments have been brought to bring it in line with the those provisions. Rest, I think we have dealt with it in detail in our slides. We'll circulate the slides to all the participants. Now, I think I'll hand it over to our GST team, to indirect tax team, to take it over. Sorry, I'm not,
no worries at all. Good evening, everyone. So I'll just wait for Saksham to fire up the indirect tax related slide deck and probably, just go through the major themes that is emanating out of this budget. The union budgets of past used to be something where the TV's channels used to run, their bulletins throughout the day that this has got cheaper, that has got more expensive. So we have moved away from that. We are seeing more and more changes with respect to procedures and the law as far as the customs or the GST Act is concerned, GST statutes are concerned. So first of all, let us just glean over the major changes which are emanating out of the customs amendments this year. The major changes which everyone has been talking about is, of course, with respect to the definition of proper officer and what actually comes under the definition of proper officer. So this is a lacuna which was probably created by Canon India. And of course, there have been other judgments as well by the Honorable Supreme Court in Commissioner of Customs Preventive versus Syed Ali as to whether officer who is not who is the assessing officer with respect to a particular import can issue show cause notices or adjudicate or investigate with respect to imports. So in the indirect tax laws in our country is quite unique to the extent that not only you have to submit to assessment or investigation from your assessing officer or your your field formation, you also have to, there is also a separate layer of checks created within the customs department, within the customs house of that particular importer, as well as there are umbrella omnibus bodies such as the dreaded DRI, which basically looks at every import as a probable smuggling offense. So Canon India kind of laid down the law that an assessing officer who has assessed that particular import is the only officer who can reassess that or investigate that import. And the purport was with respect to the wordings of Section 5 and Section 2, subsection 34, which basically provided that if at all, so show cause notice or investigation is to be issued, it is to be issued by the proper officer, and the proper officer was read to be someone who was the person who was the officer who had assessed that import originally. Now, Canon India said that a DRI does not essentially come under the purview of the proper officer. They have, to a large extent cured this by way of amending the sections, and they have actually done two things. They have not only provided for different similar omnibus officers as proper officers, in addition to the field formations, such as DRI, Commissioner preventive, etc. They have also said that further officers can be notified by the CBIC. And what is interesting to see is that it looks like that there are two trends emerging out of it. One is definitely with respect to DRI, which you have spoken in detail now. It also looks like that they would be going for center of excellences, such as valuation, such as rules of origin, such as type of goods and stuff like that. Simply because, and this is in a way a welcome move, because from our experience, we have seen that there are certain there are certain specific areas of law, such as valuation and rules of origin, which probably is left best to the experts, and there needs to be center of excellence within the customs organization to adjudicate and investigate those issues, and leaving those to the mercy of the assessing officer who is in the field formation at that point of time is of no use. Mr. Kapoor, any thoughts on this?
Yeah, so with respect to the specific, amendment in proper officer, the definition which is being broadened to include your any officer, because you have rightly touched upon the judgment of Canon India, which had two aspects. One aspect being that DRI or Director Revenue Intelligence Officer or an audit officer or a preventive, person who was conducting search and seizure was not a proper officer as rightly held by Canon India. So what they have tried to do is with retrospective effect, make certain changes in the definition of proper officer. Now, this may open up a Pandora box also, because this goes back to almost 4 years. And what happens to the kind of matters in which show cause notices were issued by DRI and which were quashed by various writ petitions which were filed across India on pan-India basis. Whether those show cause notices will now be reinstated or they are laid to rest. So that needs to be seen. But even prior to Canon India, there was one judgment by Delhi High Court which was in favor of the SSE, and one Bombay High Court was against the SSE. And therefore, there were a lot of circulars which were issued post 2011 in the post Sajid cases. And the aspect of bringing in may have a wider implication and ramification to industry at large.
Yeah. Sure, thanks for that. Can we just quickly move on to the clause 88 related? Next slide, please. Yes. So this is an interesting amendment that they have brought in. Before this, the valuation related provisions were the rules of with respect to valuation of import or export, as the case may be, or it would be provided under whatever is section 14. Of course, the valuation rules were under our treaty obligations with WTO, and that actually provided for that the officer can only can only ask for details with respect to unrelated party imports, etc., when he has a reason to doubt such imports. And in a number of judgments, it was held that that a reason to doubt has a higher threshold than reason to believe, and that has to be cogent. There have to be cogent reasons to doubt valuation rather than just nascent things. So on that basis, what they have now done is that they have brought in an amendment within section 14 itself to provide for a mechanism where unrelated imports can also be doubted when there are trends emerging out of it. So there have been, one thing that comes to my mind is, of course, what happens to the DGOV circulars or other alert circulars with respect to specific imports, mostly metals, where prices are taken from London Metal Exchange and other repositories. And in recent judgments of the tribunal, such as Baheti Metals and Agarwal Metals, we have seen that the tribunal has ruled that those London metal exchanges cannot form reason to doubt such, doubt such pricing. So it needs to be seen how this plays out and how they actually go hand in hand with our treaty obligations with respect to valuation rules. So we can quickly move on. Rest of the changes with respect to advanced ruling, I'll just quickly touch upon one small thing which looks, other than the housekeeping changes in section 28E and section 28H, there has been, and 28I to a certain extent. 28J now provides that an advanced ruling would only be valid for 3 years. This looks like a step in the wrong direction, because earlier it used to be valid till the fact or law would have been the same. This reminds us of the SVB 3 years era, when every 3 years the importer would have to go to the SVB to renew their SVB order. So it's just an added layer of hassle to it, in my view. We can move on to the, yeah, I think we can skip this. So just quickly touch upon the part that out of the tariff changes, of course, there are 2 changes happening in 2 tranches. And one particular important thing that we would like to highlight over here is that the project import related rate has increased from 5% to 7.5%. And it is quite surprising given the fact that there is an infra push. We understand that it is to somehow harmonize with the BCD rate at this point of time, but it could have waited, in our view. We can move on. Saksham, next slide. Saksham, next slide. We can skip this. Yeah. Coming directly to CGST related changes, and of course, this would also be relevant for the entire GST statute, the entire gamut of GST statutes. And what is interesting to see over here is that before goods and services tax came about, my eligibility to take credit was only with respect to few conditions which were mostly under my control. I should have received a supply, I should have had an invoice, and I should have paid my supplier. Those were the basic things. GST and certain pre-GST VAT statutes added a second layer, which said that the supplier must have also paid that tax onward to the government. Now what they have done is they have added a second layer of addition, which basically says that not only he should have paid your tax, but he should have been compliant in other things as well. And unless he is compliant, his tax, those taxes which are basically he has paid in respect to you, would appear as blocked credit in your statement, in your inward statement, which will be known as GSTR2B. Also important to see over here is, and probably we can look at next slide with respect to that. Yeah, we can move to the next slide as well. Yeah, so it has done away with a two-way communication, which was basically proposed initially with respect to goods and services tax. And now what you are left with is only the one-way communication from the supplier. So one interesting question that comes to our mind, and certainly is an issue: what happens to credit notes? If today I do not pay my supplier because he has not provided the credit on time, and I wait for him to put that on the portal, and then I pay it to him, and tomorrow within the given time frame he uploads a credit note, will I be required to reverse my credit? The law provides for a very different thing. Law says that his output tax liability is contingent on me reducing the credit. But here the system is giving an idea that my credit would be reversed regardless. So there is definitely a friction in the two sets of provisions, and we'd need to see how that plays out. And what the third trend coming out of this is that they're completely doing away with that provisional business of claiming credit. Everything would be final. Whatever comes on your statement, that is all you can take. If he has not paid, then you chase him for uploading that detail. And if you by mistake claim it before he uploads it, or it is in a blocked state, then you pay interest on it. And this certainly goes against the idea of Arise India and other judgments which had said that I cannot be penalized for my supplier's mistake. And here, the interesting bit to see is that I am not being penalized for mistakes that he has made or defaults he has made with respect to my transactions. I am being penalized for some other transaction entirely. We would really have to see how the courts view this amendment. Mr. Kapoor, any thoughts?
Yeah, you have rightly stated the judgment of Government of NCT of Delhi versus Arise India, which categorically stated that if the purchaser has the tax invoice and he has also paid the taxes, then he is eligible to claim that taxes. Now, what this provision is trying to do is, there have been actually in the last 4.5 years, there have been a lot of cases of fraud. And almost to the tune of 45-50,000 crore government exchequer has been robbed. So just to cut all those aspects in line, they are bringing these kind of an amendment to cut those loopholes and the fraud which have been committed. So whosoever is a seasoned person who is filing his return and paying its taxes on time, this one-way communication, which is now going to be there, which is already there actually for the past 3 months. It's only this is being legislated through by bringing in and through the parliament. But it's already been there for the past 3 months. But the fact of the matter is that they don't want to penalize those dealers who have been paying their taxes on time, but only to cut those loopholes or those fraudsters, those who have been actually frauding the revenue at large.
But how far do you think it is, fair for me to be expected to police my suppliers, that you not only pay my tax, but you also pay your past taxes and file your returns on time and pay your taxes as per the proportion that has been provided under law, particular percentage in credit, particular percentage in tax. Do you think that it's fair to?
No, I mean, this amendment will come in from effect, the day it is passed by the parliament. But the vendors or the dealers are advised that they can do a due diligence check from today onwards, that whosoever are the vendors who are paying their taxes on time, reporting it on time, and who are the kind of defaulters, those who are, despite of the fact that the purchaser has paid the tax to the seller, but they are not reporting it. So they have to be after them and try to see. And now credit rating and all that will come into effect. And therefore, it is important for all the dealers or companies to do that dual check with respect to the vendors. But I personally feel, it will be definitely challenged before court of law. And the courts may take the view which they have already taken in the case of Arise India.
Certainly. And of course, before we wrap up, we should also highlight that there have been certain welcome changes, such as most of the statutory time periods for rectification of invoices, issuance of credit notes, etc., has been further extended by 2 months. 30th September has now become 30th November to be in sync with the annual return calendar. Although that calendar itself has been pushed over a number of times for the past few years due to the pandemic. So I think we can wrap up here and hand it back to Mr. Jain for his closing remarks. Or if Mr. Kapoor has any other comments with respect to that, probably we can go with him.
Yeah. So the saga actually continues, right from 2017 onwards. It started with the concept of seamless credit, and then in between there were a lot of checks with respect to whether the ITC would be allowable, and a lot of circulars have come into the way in this 4.5 years, and now this provision. Though it may be a welcome from the past aspect that it is not a two-way. It's only once you're communicated that this is your ITC available on 2A, which is visible, that is what is admissible to you. Though it may be hit for the companies that the working capital may be hit hard for them, but they need to do that due diligence check for them. Though there are some welcome changes as well. There's a lower rate of interest, though again retrospective from 2017 with respect to if you have wrongful availed your credit or utilized it. But the other aspect which is welcome is that if you have availed but not utilized, then no penalty to be charged. Those certain matters are already pending before various high courts on this count. So these slides are also available along with the slides with the direct tax, and it will be made available to all our guests who have been, part of the discussion in the house. Over to you, Neeraj, if you have any other aspect to be dealt on to.
Oh no, thank you, Shami. We'll be circulating the slides, both the slides very shortly. And so thank you everyone for taking out time and to be with us for this best part of this Friday evening. I would be failing in my duty if I don't mention that this all this effort and the hard work was put in by our colleagues and friends who have been tirelessly working and then behind the scene and doing all the doing all the hard work to make it possible. We will also thank Mr. Ajay Vora, Senior Advocate, for being with us this afternoon and sharing his valuable input and comments for our audience, for our audience and participants. So thank you everyone. Have a nice weekend.
Thank you.
Thank you, everyone. Thank you.